business with these. You can measure the progress of your business by comparing these financial statements with the previous years or with other businesses. Okay. And then you have accounting ratios as well, which is like the accounting part. Okay, it's not the bookkeeping. The accountant is gonna come and do some ratios and stuff, and then it's gonna be like, oh yeah, you should do this, you should not do this, that kind of stuff. Okay, so it's used to measure the relationship between figures. Fine, fine. Ratios is an entire chapter. It's like chapter 21, and it's quite okay. We're gonna go through it tomorrow. All right. Let's move on to assets, liabilities, and capital. A little more detail. Assets, we already talked about it, and liabilities, we already talked about it. Capital, and this is a little important of a definition. By the way, if any questions on what we just discussed, please ask right now. Yeah, exactly. It is. Is that it? All right then. So capital is the total resources provided by the owner and represents what the business owes the owner. Fine. This second part represents what the business owes the owner. This is something you have to remember because when I'm going to be explaining chapter 19, which is partnerships, I'm going to ask a question which will need you to, I don't know, have this in your mind. Okay. So the definition of capital is anything you invest into the business. It can be money, it can be a car, it can be anything, okay, that you invest as the owner into the business. So it's resources provided by you as the owner to the business. And then it's also whatever the business has to give you. Okay. So if you give a car to the business has to eventually give the car back to you because you know it's your car and the business is just kind of borrowing it. Okay, so that's what it means over here. The business owes the owner. Okay, so anything you put into the business owes it to you. And then sometimes you don't really put something into the business still owes you something. Okay, maybe profits. All right. Now let's go to the accounting equation. We have three things in our accounting equation. We have assets, capital, and liabilities. And as we just discussed, this is the stuff of the statement of financial position. We have our assets, liabilities, and then we have capital as well. So in your accounting equation, it's just these three things. We know the definition of each three of them, by the way. So we start with assets equals to capital plus liabilities, and there is a whole, reasoning behind it. It's not just random, I don't know, random words together or something. So the assets of a business, which are the resources or anything used by a business, are always equal to the liabilities and capital. You can check this; it's pretty cool. The resources provided by others. Now you see they don't just include capital; they have capital and liabilities because both are resources provided by others. So the resources used by the business will always be equal to the resources provided by others because where did you get these resources? From capital and liabilities. Does that make sense? All right. The assets represent how the resources are used, fine, and liabilities represent where they come from. Okay, let's look at this example. Oh, we have a few more stuff, a few more definitions. Lena set up a business to trade under the name, fine. Opened a bank account and paid 20,000 as capital. So the amount she invested into the business is 20,000. The amount the business owes her is 20,000. Okay. The business purchased premises. This is, basically buildings or land. So the business purchased an asset for 15,000. The business purchased goods, which is also an asset because now the business owns these, right? The business sold goods. This is not an asset and not a uh, not a liability, but this is reducing your assets because your goods are reducing. Okay, and what I just said is what they're saying. Right? How does Oh, sorry. On credit. When you see on credit, this means that the we did not pay yet. Okay, so it's a liability for us because we have to pay later. All right. So as you can see, the liabilities are increasing by 300 because of this entry, and the rest is just what I said. Purchasing on credit means the business is on pay immediately. A new asset inventory has been acquired. Whenever you buy goods, you record it in inventory account. Okay. There's no goods account or purchases. There is a purchases account, but that's for something else. Okay. That's for purchasing the goods. And then inventory account is a final account where you only record stuff at the end of the year. Pretty cool, right? It's not. Anyways, but the business owes money to the supplier which is, this liability 3,000. And when you refer to this liability, you don't just say liability. There's a name for it. You call it trade payables. Okay. So inventory is the goods a business has available for resale. Trade payables is the amount the business owes to credit suppliers of goods. So for example, you buy goods and you don't pay the supplier. So that's a trade payable because you have to pay him eventually. And then trade receivables is quite the opposite. When you sell to someone on credit and they go like, I'll pay you later. So the amount you will receive from them, that's trade receivables. All right. A little more detail into the statement of financial position. This is the final version. Okay, so you have assets. This is the debit side and this is the credit side. We will look at what debit and credit is in chapter 2. It's quite simple though it's pretty important. All right, so the debit side you could say is the left side where assets come, and then credit side is where liabilities and capital come. All right, and they are, as you can see, balancing. They're equal. This is a horizontal financial statement. Later, we're going to do vertical financial statements. Okay, and in our exams, usually we do vertical financial statements. And then assets can also be divided into different types. And, we show them separately as well. Same for liabilities, and capital can have a little more detail. All right, there's going to be a few more things to add in capital. It's not going to be just capital. All right. This means that it's necessary. Fine. Day-to-day business transactions are recorded using the double entry bookkeeping. And then these financial statements, which are like final accounts, they're only prepared periodically, maybe 6 months, maybe 3 months, maybe 1 year. Okay. Or, it's going to be like at the end of the year, usually for our questions at least. We're going to do 11 chapters. We're going to do from chapter 1 to chapter 11. Okay. Let's check how much time I estimated for this. Okay, I estimated it's going to take 20 minutes and we finished it in like 12 minutes. That's nice. All right. Now moving on to double entry bookkeeping. Any questions for chapter 1, by the way? We discussed what assets are, what liabilities are, and what capital is. We discussed what inventory is and what trade payables and trade receivables are. And we talked about the accounting equation, which is assets equals to capital plus liabilities. And remember, of course, you can use some algebra, you can do some crazy stuff. You can also go like capital equals assets minus liabilities, that stuff, all right? And yep, I think I've pretty much covered everything. I don't think there's any questions because nobody really asked. Let's have a look at a few MCQs. A business had 9420 in its bank account. The following transactions took place. So the current balance in the bank account is 9420. If you buy goods on credit, meaning you buy today and you pay later, does this affect your bank balance? You pay later. So I don't think it does, right? And then you sell goods on credit. Did you receive any money? You did not. You sold goods, amazing. You made a profit, fine. But what about the money? You didn't get it. Why? Because it's on credit. Okay. Meaning the customer is like, I pay you later. I'm actually broke right now. All right. So this also does not affect your bank balance. And then repaid a loan by check. Check, I'm pretty sure most of you are familiar with the term, but it just means a bank payment. Okay, when you pay someone through the bank, you just give them a check and then they just go to the bank and they go like, hey, check this out, check this check out, like that. Okay. So yep, this is gonna reduce your bank balance by 5,000 because of course if you're paying someone repaid, if you pay money out of your bank account, your bank balance reduces. But if you have no money, that's a different story. But we're not talking about that. Okay, then 9420 minus 5,000, probably 4420. What's a statement of financial position, guys? Please answer this quickly, quickly. Come on. It's not that deep. It's not that difficult, right? B. Okay. Does anybody else? Okay. Anyone else? Like see a list of everything owned by and owed to a business. Okay. Very good. Let's go into detail. Owned by is something you own, which is fine, an asset, right? Pretty simple. Owed to, meaning others owe you. Okay. So if others owe you something, is that an asset or a liability? When you sell goods on credit, the customer owes you. So when other people owe you, is that an asset or a liability? Are you sure? This is an asset, by the way. Asset is something you own or something others owe you, and a liability is something you owe to others, meaning you have to pay it to someone. Okay, are we paying anything if someone owes us something? They're gonna pay us, okay, not us. We won't pay anything. So this also is an asset. Okay, so this is just wording to confuse you. And a list of everything of asset and asset. No, we have more things in the statement of financial position as well. We have our liabilities too, and we have the capital as well. Similarly, in part A, they have owed to calculation of the amount owed to the owner of the business. This is also just trade receivables and stuff like it's an asset as well, or it can be capital as well. By the way, to be honest, the answer might be A, and it can be B as well because like it is a list of assets and liabilities. But eventually, the purpose is to find you the capital, right? Anyways, let's just have a look and confirm. Pretty sure it's gonna be B. Where is it? Oh, too far, too far. There we go. Test yourself. ESQ. Yeah. 3 is B, 4 is B. That's it. Okay. So the answer is B, and this is also B. Okay, so those of you who said B, congratulations. Those of you who said C, I'm pretty sure it's clear now what assets are and why the answer is not C. Is it clear, please? Let me know. Bet. Oh, let me claim that rep. No problem. All right. Clear. That's good to hear. Okay, can somebody tell me why the answer is not D? Wait a minute. No. Okay, never mind. Yeah, why the answer is not D? Because it literally is not. Okay, we did not discuss anything about that. And then a calculation of the amount owed to the owner of the business. This is capital and it can be an asset as well. So this is also not that because we're talking about two things and not just one thing. Okay, let's move on to the next chapter. Double entry bookkeeping. So this is, as the name says, it's going to be bookkeeping, what we discussed before, and bookkeeping is simply recording transactions. Okay, so whatever happens, you record it. Okay, double entry means that whatever you record, it's going to be recorded twice. There's going to be two entries for it. For example, you buy goods and you pay cash. What are the accounts affected with this? Like what can be affected with this? The first thing is your cash, right? Because if you're paying you buy goods on cash, you're paying money for the goods. So, hey, bro, I said cash, not bank. Why are you putting bank? Okay, anyways. So, you buy goods, by the way, it's not going to be receiver. Anyways. So, you buy goods on cash, your inventory increases because, more goods, and then your cash decreases because you paid money for that. Okay. So, that's two accounts being affected. So we're going to record it in both accounts. All right. That's the purpose of double entry bookkeeping. Any transaction you have, it's going to be recorded twice. Okay. Once on the debit side, once on the credit side. Now, what is this debit and credit? We're going to look into it. All right. It's impossible to prepare a statement of financial position after every single transaction. Yes, manually, but then like today's world, everything is computerized, so it's pretty simple. You just do the bookkeeping and then the computer prepares the statement of financial position, right? Very cool. Anyways, the day-to-day transactions are recorded in the books of business using this double entry bookkeeping, a system of bookkeeping we just talked about. This double entry because there's two effects of a transaction, a giving and a receiving. Like I said, if you're paying for if you buy goods on cash, what are you giving? You're giving cash, and what are you receiving? You're receiving goods. Okay, so both of these are going to be recorded in the ledger. Let's go, bro. I can't even react to that message. Anyways, all right. Now there is this thing called ledger account, okay, and it's pretty much this T account thingy, all right. So every account, like every type of asset or expense or liability, pretty much every single thing has its own ledger account, okay, has its own T account. So for example, inventory has its account, cash has its account, and like any expense, rent, insurance, interest, whatever has their own expense, has their own T accounts. All right. Every transaction is recorded in the ledger relating to that particular item or person. Fine. A ledger is a book which where each account appears on a separate page, but we don't really, I mean, we just make the accounts. Anyways, this is the layout of a ledger, which is like, a T account. You start on the on the left side is your debit side, on the right side is your credit side. Please don't mess those two up, okay? That's pretty important. But eventually you're gonna get used to it. You have the date on the debit side and the date on the credit side, details as well, and amounts as well. Pretty much simple for now. Okay. Now we abbreviate the debit side into DR and CR for the credit side. And yep, everything else is folio is not really something you have to worry about, but it's if you're just curious, then it's just for references, all right? It doesn't really make a difference. It's not something we have to do in our syllabus at least. Okay, so every transaction is entered twice, once on the debit side and once on the credit side. And this is something which will probably help. Credit the giver, debit the receiver. Okay, so whichever account is receiving or gaining value, you debit it, and whatever is receiving value, you credit it. But some people, like, they think that debit side is good and credit side is bad. No, that's not the case. Okay, like assets are debit, which means that if you increase your assets, the debit side will increase. Okay, fine, that sounds good. But capital is credit, profits are credit, sales are credit. So you can't say that one side is bad and the other side is good. Okay, you just yep, that's you just have to understand that both of them are equal. Yeah, because what's it? The debit side has expenses as well. Anyways. Ajay began business. He opened a business bank account and invested 80,000 as capital. This is our capital. He bought goods and paid for by check. So our bank balance reduces because we're paying right now. It's not like we're paying later. And let's have a look at how this stuff is recorded in the what's it in the ledger accounts. Okay. So when you invest $8,000 in your bank account as capital, what happens? Your bank balance increases, right? And let's just kind of say this bank debit because it's increasing. We'll talk about why later, but we're just debiting bank right now, okay? And then we're gonna credit capital for 80,000 because our capital increased, right? So we debit bank because invested in the business bank account. So your bank account balance is increasing, and we debit credit capital because our capital is increasing by 80,000. And you can see that let's just do the second one first. Fixtures and equipment were bought for 30,000 and paid for by check. When our bank balance increased, we debited bank account. Right now, our bank balance is decreasing. Will we debit bank account or will we credit bank account? To increase it, we debited it. What do we do to decrease it? Credit it. Perfect. So it is going to credit bank account by 30,000. And do we debit something? Of course, we debit something. But what do we debit? Fixtures and equipment. Why? Because we're buying it. It's an asset. It's increasing. So let's just write fixtures and equipment and 30,000. Now you can see in this bank account we have fixtures and equipment on the credit side because we credited our bank account. So this is the credit side of the bank account. On the credit side, we had fixtures and equipment 30,000. And we debited our bank account at the start in the first entry, and we credited capital, meaning when you write like on the debit side of your bank account, you're going to write capital and 80,000. And then in your capital account, you have bank. You have credited the capital account with bank. So you can see that it's on the credit side once and it's on the debit side once. Okay. So this is double entry. So now when you prepare your statement of financial position, the assets are gonna be 80,000 and the liability the capital is gonna be 80,000. So it's gonna balance. Okay. That's why you need to record it on both sides. So your statement of financial position balances. All right. And then in the fixtures and equipment account as well, we have debited the account. So as you can see, it's on the debit side. We have bank 30,000. All right. This is just an explanation of what we just did, but I explained it already. So if you want to go through it, you can. Doesn't probably doesn't make much of a difference. Okay, now assets and liabilities, expenses and income, drawings, And there's probably capital as well. They don't say capital. Okay. All right. They all follow pretty much the same concept, but just let's just go through it to kind of clear it up, okay? So a ledger account is open for every asset and liability, every expense and income, for drawings, for everything, okay? The double entry principle, every transaction is entered twice. The receiving side is debited and the giving side is credited. Let's just look at one example. A loan was received from AB loans. So when you receive a loan, what's happening? Your cash is increasing, right? The amount of money you have increases. So your cash increases, debit the receiver, your cash is receiving money. If you're receiving money in your cash account, so you debit your cash account. And who's giving the money? Where are you getting the money from? It's from AB loans. So you just credit AB loans. Now let's look at our cash account and we're gonna find AB loans here. It's on the debit side. As you can see, we debited our cash or bank and we have AB loans on the debit side. And then on AB loans account, we're gonna have bank on the credit side because we credited AB loans account. All right. So as you can see over here, pretty simple, very cool. Let's look at another example. A motor vehicle costing 9,000 was bought and paid for by check. When you pay money, your bank balance is reducing. It's giving the money. Okay, so you credit your bank. And then what's increasing? Where are you getting the money? What's receiving the money? The motor vehicle, all right? So you debit your motor vehicle. And as you can see on the credit side of our bank account, we have motor vehicles 9,000. And then in the motor vehicles account, we have bank on the debit side 9,000. Does that make sense? Any questions? If yes, then please ask. Thank you, bro. Appreciate it. Hey, let's go let it like that. All right. Now for expenses and income, it's the same thing. Expenses are debited and incomes are credited. Let's look at what that means. Just a second. I'm gonna connect my charger because my laptop's dying. It's kind of hot in here. Okay. Do all of you have an exam on Wednesday, or like did some people join who have an exam in later sessions as well? Well, I guess most people are gonna wait for tomorrow or something, or some people might actually be waiting to join late because like we're stuck on the basics for now. But the basics are important too. Wednesday, okay, okay. Hey, thank you, thank you. All right. Anyways, let's get back to this. So, all right. Double entry records for expense and income. Let's look at an example right away. Began business, 80,000 capital in the bank account. We know how to do this, right? All of us know how to do this because we just did this twice. So the first thing you do is you debit your bank account because your bank balance increases, it's receiving the money. So credit the giver, debit the receiver. Who's giving the money? It's you. It's like your capital. You're receiving money through capital, 80,000. You're giving money, by the way, sorry. And you're receiving money into your bank account. Another way to look at it is that maybe Stream doesn't like me. That's kind of sad, low key. But for you, bro, just for you, I'm gonna share it again. Let's do this. That should work. Hopefully, it works. Anyways, okay, that's one entry. Now let's look at something else. Let's have a look at this. Paid rent of premises by check 400. So when you pay rent, your bank balance reduces. What do you do to your bank account? Do you debit it or do you credit it? I don't know what you do, but I'm gonna credit it. Okay. We're gonna credit bank by how much? By 400. Why? Because we're paying 400. All right. And then we're gonna debit what? What else is there? We have rent of premises. This is an expense. We're going to debit the expense account. Exactly. So we're going to debit rent. Okay. But how do I remember what to debit and what to credit? Like, I'm definitely going to forget that I have to debit the expense and credit the income, and that I have to maybe debit the assets and credit the liabilities and stuff, right? So, well, there is methods, and there is this super duper cool method, right? You can go like PEA, and then you can put it, and then you can go like RLS, or some people use another mnemonic. They go like DEAD, and then they go like CLIC, right? But then I just like this one because it's just cooler, you know what I'm saying? All right. Anyways, so this left side is the debit side, and this right side is the credit side. And this mnemonic right here is gonna help us for D accounts, and it's gonna help us for the trial balance. So it's gonna help us for a bunch of things. There you go. All right. So P stands for purchases, and E stands for expenses, and A stands for assets. These three are debited, okay? They have like positive debit balances. They increase on the debit side. Then you have revenue, which is basically incomes. We have liabilities, which is we discussed it, and then we have sales, which is pretty much sales, bro. It's not that deep. Okay, so that's it. Now we discussed so far about expenses being on the debit side, which we just did, you know, rent expenses on debit side, and we discussed assets being on debit side, which was the previous question. We also discussed liabilities being on the credit side, which was the previous question. Now we're going to talk about purchases and sales in the next part. And revenue, we can probably find something here. Let's go. This is revenue. Part of the premises were rented out to another business and a check of $95 was received. You receive money. It's 11:36 a.m., bro. I had to wake up early for this, you know. I'm such a cool guy, right? Okay, anyways. So part of the premises were rented out to another business. So, you know, you're receiving money from them, you're renting out to them. They're gonna give you money. Your bank balance increases. When your bank balance increases, you're gonna debit your bank account because why not? And then by $95 because that's how much you receive. And if you're debiting your bank account, what do you credit? You credit the rent receivables account because it's an income and because there is literally nothing else to credit over here. Like, what else are you going to do? Okay, and you need to credit something, by the way. You can't leave it blank because if you leave it blank, then it just will not balance. Okay, so we're going to credit rent receivables for $95. Now, one tip I want to tell you guys for your exams, if the question says rent only, then it's an expense. Okay. If it specifies rent receivables or like, you know, rent was received, then that's an income. Okay. That's rent receivables. If the question does not say receivables, it's always going to be an expense. Okay. Super cool. Let's look at our answers. For the first entry, we debited bank account with 80,000. So on the debit side of bank account, we will find capital, and that is correct. They have the correct answer. Then for the second entry, we credit our bank account with 400, and yep, that's correct. And then the rent account, we're going to look at it later. And then for the third entry, we debit our bank account with 95 and credit rent receivable. Perfect. Let's look at the individual account. So let's look at capital. We have bank on the credit side. As you can see, if it's on the debit side here, it's going to be on the credit side here. Very simple. Then we have a rent payable account. Let's have a look at it. Where is it? Rent payable. As you can see, it has a debit balance because you know it's an expense, and then bank is on the debit side, and over here rent payable is on the credit side. So we have one debit entry and we have one credit entry. Okay, the last thing, it's pretty much the same thing. By the way, it will hopefully if they're recording it. If not, then I'm also recording it and I will hopefully upload it on my YouTube channel. Maybe, probably. Okay. Anyways. So, yep, back to where we were. Rent receivable, it was debited in the bank account. It's going to be credited in the rent receivable account, as you can see. Yeah, it is linked in my profile picture. Bro, you don't have to call me sir, man. I'm not that good. Okay, anyways, so I am pretty cool, right? I know. Thank you. Okay, that's it. Now let's look at double entry records for drawings. Drawings is a new word for us. Let's take a break here. Just joking. Let's not take a break here. Drawings basically means when you draw money. Yeah, like when you pick up a pen and then you draw money, and then the government, I don't know, does something to you. That's not drawings. When you draw money from your business, when you take money out of your business. Okay, so you have a lot of money in your business, and you suddenly want to buy a Bugatti for yourself randomly because why not? So you take all of that money out of your business and then you buy a Bugatti. But can you call this Bugatti your business expense or something? You cannot because it's your personal expense. So when you take money out of your business, This is going to be drawings, and you're going to record it as drawings, and it's going to be like 5 million drawings. That's crazy. So of course, if you have a business, you wouldn't really want to take a lot of drawings. Okay. But it's your business. It's literally your choice. You own it. Who's going to stop you? All right. Drawings represent any value taken from the business by the owner of that business. So it's not necessarily money. What if I am having a shop for food and every day when I go to my shop, I eat a bunch of food? There we go. That's drawings as well. Probably. I mean, it is, but like most people probably don't record it because it doesn't really matter. So, anyways, this is drawings. The value may be money, non-current asset, or goods from the inventory held by the business. It's usual to open a drawings account to record these values so that the capital account does not have a large number of entries. Now, eventually, what drawings does, is that it reduces your capital. So let's just say you invested $100,000 into your business, and then tomorrow you have to buy a home, and you take out $90,000 out of your business. Does your capital change? Of course it does. It reduces by $90,000, right? That's like a lot of dollars. Okay. So your capital is reducing, but you don't record it in the capital account. Why? Because capital account is like a final account. Okay. It's something you prepare at the end of the year. If you start putting every single thing in your capital account, it's going to be too crowded. And we don't really want that in accounting. Okay. So we have like accounts for every single thing, just so some accounts don't get crowded. Okay. So that's why we have a drawings account. We record all our drawings over there. And then at the end of the year, we, take the total and then post it into the capital account. Very cool, right? Okay, drawings are going to be debited to the drawings account because like very simple logic, right? D for drawings, D for debit, that's a good way to remember it. But then a way to understand it is that since capital is credit positive, because the accounting equation literally goes like A equals to L plus C, this being the credit side and this being the debit side. So since capital is on the oh my God. Since capital is on the credit side, the opposite of capital, which is drawings, is going to be on the debit side. Very easy. Okay, when money is withdrawn, either the cash or bank account will be credited. Why? Because if your cash or bank is reducing, you're going to credit the cash or bank account. Super cool, right? And then you're going to debit what? You're going to debit drawings. Okay. And yup, let's look at balancing ledger accounts. Now you see how over here we have our bank account like this. Is my voice lagging or am I just making it lag? Chat, if there's any problem with my voice or the stream or whatever, just say it, bro. Okay, so as you can see over here, let's go, man. Appreciate it. As you can see over here, we have our our yeah, back to the topic. We have our bank account, but do we know our bank balance at the end of the month? I mean, fine, we can calculate it. 80,000 plus 10,000 plus 5,000, that's like 95,000 and then $95. So 95,095 minus 400 minus all of this on the credit side. But that's a lot of work. Like when I want to know my bank balance, do I really have to do all of this stuff? Is it really worth it? Is accounting even worth it? Okay. So to answer that, we have this thing called balancing ledger accounts. Okay. Let's look at our bank account now. Ooh, it's done for us. This is our bank balance 55,395. But how did this happen? It's not magic, probably. So you go over here and here you go. This is your bank account. You total this side and you total this side. And then whichever side is bigger, usually the debit side, because you want to have a positive bank balance. So you want to earn more than you pay. But some businesses don't really care about that and they have a credit balance, which means they have a negative bank balance, just like someone I know. Anyways, so yep, you total this, and then balance CD, which means carried down, comes on this side, and you're gonna, make the totals equal, and then you're gonna do balance BD. It doesn't make much sense, does it? It will now. So you have an example here. The total of this side is 95.95, like we calculated, and the total of this side is not really 95.95, but we can make it 95.95. How? By adding whatever we need to add. Okay. Now this remaining stuff is the balance, the amount we receive minus the amount we paid is the amount we have. And that's how you balance a ledger account or a T account. Okay. On a calculator or a separate sheet of paper, add up each side and find the difference. Enter the difference in the next available line, which is the smaller in money. In our case, the smaller in money is the credit side. So we're going to put balance CD on the credit side. As you can see, CD, which means carried down, the total each account, and fine. The total will be same for both of them. After you have the balance thingy, as you can see, after the balance, the total is same. Before the balance, it was not the same. Make the double entry for the balance, carry it down, fine, fine, fine. You're gonna CD and then you're gonna BD for the next date. As you can see over here, they have a weekly bank account system. So at the end of the week, at the seventh day of the month, they're closing their bank account and then they're opening, balance BD again for the next week. Okay, now sales, purchases, and returns. So like we have, if you have sales, you also have sales returns. Very cool, right? And then if you have sales returns, oh wait, if you have purchases, you have purchase returns as well. Because maybe you bought the goods and you don't like them, so you want to return them. But in accounting, we have to account for everything because we are accountable accountants. That sounds good, right? Anyways, it's necessary to open an account to record goods which are purchased for resale, which is, actually goods we purchase, and also an account to record goods which are sold by the business. Fine, fine, fine. Oh my God, so much yeah. Okay, let's go right into the question. What? I am a teacher. Okay, anyways, let's get back to the topic. Ajay bought goods $650 on credit from Focus and Go. What do we do here? Well, that's a good question. I think I should explain this stuff. I don't feel like using the textbook to explain. Anyways, so Ajay bought goods from us on credit. Wait, sorry. Ajay bought goods on credit from Kolkata and Co. So Ajay is us, we are Ajay. And we buy goods, as you can see, we are Ajay. We are Ajay. Okay, anyways. And we buy goods from Kolkata and Co. This dude is our supplier. Now tell me, if you buy goods on credit from someone else, you have to pay them money, right? What do you call this? This is called a liability. Okay. And is there a specific name? Yes, there is. What do we call it? We call it trade payables. So we have our liability, and as we discussed earlier, and for else as well, if you forgot whatever we discussed earlier, liabilities comes on the credit side, they increase in credit. Over here, our liability is increasing by 650. So we credit our trade payables, or in this case, we credit Kolkata and Co. by 650. And what else is happening? Your goods, your asset, your inventory is increasing. How is it increasing? It's increasing by 650 because you literally bought goods, bro. Okay, the next one is the same thing. So you debit purchases and you credit cash or bank, in this case, sorry, you credit bank because your bank balance reduces. As you can see over here, we have purchases 150. We are crediting the bank account, and then we have, what is this, bro? Oh, okay, never mind. We paid full for that. Sorry, sorry, sorry. Okay, over here. We have purchases 650. This is us purchasing from Kolkata and Co. We don't write bank or cash because we're not really paying. No, I was saying sorry to the textbook because I was mad at it. Like, why does it have bank over here, Kolkata and Co in the bank account? But I did not read this line, so it's kind of my fault, right? Okay, so in the Kolkata and Co account, when we purchase the goods, we credit the Kolkata and Co account like we did over here, and we debit our purchases account because we are purchasing goods. Okay, and for the other one, we debit our purchases and we credit our bank account because we are literally paying. And then later, when we pay the amount owed to Kolkata and Co, we are going to credit our bank as well. Why? Because your bank balance is reducing. And what are you going to debit this time? You're not going to debit purchases because we're not purchasing any goods. You're going to debit Kolkata and Co because the liability, the amount you owe them is decreasing. Okay. So first you owe them 650. When you pay them 650, you owe them zero. Okay, and as you can see over here, we pay them 650, and now there is no balance on Kolkata and Co's account, which means that their account is clear, it's closed. Bye bye, Kolkata. Okay, that's very cool. The account is now closed. Hey, yeah, let's go a celebration. Okay. It's not necessary to write the month against each transaction. You don't really need to write Jan 9, Jan 9, Jan 9. You just need to write Jan and then 9, 10, like that, And then when the next month starts, you need to write Feb and then like 9, 10, okay. If there is more than one entry on the same side of the account on the same date, you don't really need to write the date as well. Like if it's the same date, which it usually is not. Okay. Now we go for sales, very much the same concept. Let's have a look at this beautiful mnemonic, which will help us throughout this life of ours. As you can see, sales is on the credit side. I usually write the year every time too. Like for every single transaction. Wow. You don't really need to. Just write it at the top. It's enough. And then like when the new year starts. Yeah, exactly. How do you get so much space, bro? I used to struggle. Wait, wait. I don't know. I never struggled, right? I'm so sick now. Okay, anyways. Uh, all right. So you have sales on the credit side, according to this mnemonic, and this mnemonic is, by the way, derived from the accounting equation. If you want an explanation on how and why, we will probably go through it later. Hopefully, inshallah. Okay. Actually, sold goods 175 for cash. So you have sales on the credit side. When you're selling goods, your sales increase, right? Very much common sense. So you're gonna credit your sales. Why not? Because it's literally on the credit side. Okay. Anyway, so you're gonna credit sales, and then you're gonna debit what? You're receiving cash. Your cash balance is increasing. So you're gonna debit cash by how much? By $175. $175. Okay. And as you can see over here, cash account 175 is being debited and sales account is being credited with cash by 175. So the textbook is correct. Our answer is of course always correct, right? Ajay sold goods 770 on credit to Frena. Can you go through those questions? Cloudy in books of isofusie if there's balance. Yeah, we will, usually, probably. Do you have them right now? I can't find them here. Like we'll go through questions or we will probably, yeah. Well, then you're gonna have to share them, big boy. Okay, Ajay sold goods 770 on credit to Prerna. So when you sell goods, you're gonna again credit sales because there's literally nothing else you do when you sell goods. I mean, you're selling goods, your sales are increasing, and when your sales increase, you credit sales. So you're gonna credit sales by how much? By 770. My stylus is acting up. Don't worry, my handwriting is not that bad. I mean, it's bad, but it's not this bad. Okay, and then you're going to debit the customer in this case. And as you can see over here, we have her own account. And when we sell goods on credit, we debit Fairness account and we credit sales account, as you can see over here. Now later, some stories happen and stuff. What happens? Let's have a look. Gave a check for 500 on account. So we receive money 500. You can talk, but like apparently you can't. Like you literally cannot. I'm okay with it, but you just cannot. Do you want to talk? If you want to talk, I can probably ask them to make you a speaker. Okay, fine. Let me ping Ahmad Saab. Oh wait, he said chat mod, right? Who is our chat mod? Is there any chat mod? Yeah, well, you will just become a speaker, and then whenever you want to talk, you can open your mic. You know what I'm saying? Like right now, you don't have the freedom to open your mic. I meant chat, bro. Okay, bro. Because like if there's someone to actually talk, it's better than having no one to talk to. Anyways, on account indicates that only part of the amount outstanding is being paid. The remainder will be paid at a later date. As you can see over here, it says on account, which means that I'm gonna pay you something today, but I won't pay you everything today because there is tomorrow. You get it. Okay. So we just receive 500. We credit the account by 500 and we debit bank because we're literally receiving money in our bank account. And that's it. That's the end of the story. You're gonna do balancing and you're gonna balance the account. Currently, this is the amount we are expecting to receive from this customer. Okay, has been balanced on Prerna is a day's debtor as an amount of 270 is owing to budget. Okay, debtor means trade receivable or credit customer, like someone who owes you money. Okay, that's it. And then for sales returns, it's pretty much the opposite. Sales was credited, so sales returns will be debited. So like for this, we're gonna have to credit sales and debit Xavier traders. Okay, I guess that's better. We're gonna credit sales and debit Xavier traders by 245. And then later when they're returning the goods, we're gonna debit sales returns. Because like if sales is being credited, then sales returns will be debited, right? Very much common sense. And we're gonna credit Xavier because we did not receive any money or anything. It's literally Xavier traders right now. Okay. Let's look at the textbook. The first thing we do is we sell goods to 45. So our sales account has Xavier traders, and then in our Xavier traders account we have sales. The second thing we do is we return the goods. So sales returns account is debited, and Xavier traders has sales returns. Is it too confusing? We won't be doing past papers today because we have so much to do. I think I'm spending too much time on this chapter now. This is not nice. Okay, it's kind of almost done. Okay, well, this is not nice. I should speed it up. Okay, I'm pretty sure it makes sense. Goodbye. Let's move on. Okay. Double entry for carriage inwards and carriage outwards. Carriage inwards or carriage itself is the cost of transporting goods. Carriage inwards is when the goods come into your business, and carriage outwards is when the goods go out of your business. Okay. Out of your business meaning to customers. So when you do delivery to customers and you are the one who's paying because your customers are so oh princess treatment, right? Like they can't pay for their own goods, you have to pay for them just so they feel happy and stuff, and so they come back to you again. So that stuff is called carriage outwards. It's a selling expense, and it occurs when a business pays for goods to be delivered to the customer's premises. And then you have carriage inwards, which is the cost of purchasing goods. Remember, cost of purchasing goods. Okay, like when you calculate the cost of the goods you have, you need to add carriage inwards to it. Okay, all right. Three-column running balance accounts. Now, so far we have discussed this super cool looking T account, right, for recording our accounting stuff. But then you have something cool, which is, you know, which is used today's world in computers and stuff, and like all the software accounting stuff. Uh, okay, anyways, so we have our three accounts, and then we have this new or other version of accounts, which is called three column running balance accounts. Running balance accounts because after literally every single transaction, you're gonna know how much balance you have. Okay, which is a nice thing. It's pretty cool. So you have your bank account at the start when you invest money into your business, 80,000, you have 80,000 money. Then you pay rent, your bank balance reduces. You buy fixtures, your bank balance reduces. You pay insurance, it reduces. You get a loan, it increases. So it's pretty nice that it shows you the balance after every single thing. It has debits and credits as columns and not like, the T account has debits and credits as sides. Right? This thing doesn't really have that. It has columns. It's okay, it's nice, fine, but we don't really have to make these accounts. We only have to make T accounts. Okay. Now this is problem. Explain each entry in the account of Xavier traders and state where the double entry for each item will be found. Loki, this is very important, but like I'm so lazy, I don't want to do this. But I guess we'll just like quickly skim through it, okay? Or I'll ask you guys. Tell me what this is. And tell me what this is. Opening balance fine, but look at the question. State where the double entry for each item will be found. And what does this mean? Fine, it's an opening balance, but what does it mean? It has a meaning. What does it mean? Money owed. Owed to or owed by? Right? Is that the same thing? Owed to and owed by? I don't know. Anyways, closing balance of previous month. Xavier owes us. Perfect. So this is the money we will receive from Uncle Xavier traders, whatever. Okay, 122. This is our trade receivables. This is an asset for us. This is something we're gonna go to Xavier every time and we're gonna be like, hey, how are you? Give me my money. Like that. Anyways, so this cash. Oh, what about this returns? And what about, yeah, what about the returns? Okay, perfect. Sales returns. How do we know? Because Xavier is a credit customer, sales. So of course it's gonna be sales returns. And if it's purchase returns, it won't come on the credit side of Xavier Traders account. It's gonna come on the debit side. Sales returns is debited and Xavier Traders is credited. You know what it means when you say sales returns is debited? It means that in your sales returns account, on the debit side, you have the customer. In our case, Xavier. So if Xavier is on the debit side in sales returns account, then sales returns will be on the credit side in Xavier Traders account. Super cool, right? Hopefully that makes sense. The rest is pretty much common. We have already done it. And then at the end, the closing balance, let's have a look at this as well. It is the amount Xavier owes us at the end of the month. Okay. All right. Let's do a quick question. Took goods costing $100 for his own use. You're gonna debit drawings and you're gonna credit what now? Goods costing $100. You're gonna credit purchases. It's not wrong to credit inventory. Lol. I mean, you have your exam tomorrow, right? Okay, fine. You cannot credit inventory because no, you cannot credit inventory because it's a final account. So you wanna leave it for the final stuff, like at the end of the year. So you're gonna record everything in the purchases account, and then eventually you're gonna transfer it to the inventory account. Let's see if the textbook actually agrees with my answer. Is it? Yep. Okay. Then we have just once purchased goods from Ali and paid in cash. You purchase goods and you receive cash. So Ali sold goods and received cash. Okay. Ali made sales. He's gonna debit this and he's gonna credit this. Repeat what? Number one. Basically, purchases is our day-to-day account. Okay, like anything that happens relating to purchases, relating to our goods, we record it in purchases. And then inventory is not something we make an entry in daily. Okay, you're only gonna make an entry in this at the end of the year or the period or the month or whatever. Okay, because this is kind of a final account. If you record everything in this account, it's going to be too crowded and you won't really be able to kind of quickly track your inventory and stuff. And like I said before, we don't want our accounting accounts to be crowded because I don't know, they just don't want it like that. It doesn't look good. Or like if you wanted it to be crowded, you could literally put sales and incomes and pretty much everything in your capital account. You could throw everything over there. Because everything does affect your capital in the end, okay? But again, we want to look cool and organized and stuff, okay? Okay, let's just move on to the next chapter, the trial balance. The thing with this chapter is that it's easy, okay? It's super duper easy, but there is a problem. And the problem is the errors. Like, oh, there's so many. Yep, all about pills, exactly. So let's just quickly, yeah, the errors is the problem. It's so much, yeah. Yep, yep, yep. Okay, let's start. Uh, what time? What time did I plan the break at? 20, 30, 50, and then like what, 30? Was that 80? And then like what, 105 minutes? We are only 60 minutes in. So after 45 minutes, we'll probably have a break, right? So we have to finish till chapter 5 in 45 minutes. Okay, we're gonna get this done, bro. All right, now I won't yap a lot unless you guys ask for questions, okay? So like if you have any questions, do not hesitate to ask, okay? Just ask. All right, it's supposed to be 3 hours, okay? It's supposed to be 3 hours, but based on how we're going so far, I feel like it might be longer, but it doesn't matter. Like it's a good thing, you know what I'm saying? Okay, the trial balance. So the trial balance is basically a list of balances. You know how in the previous questions we have all our balances over here, like the balance BD and stuff. Where is it? This is a balance, and then this is also, oh my God, this is gonna be a balance. Well, there is no need to balance it. It's like it's only one entry. Where are some balances? This is a balance. Okay, so a trial balance is just a list of balances at a certain date, usually at the end of the year or the end of the period, all right? It outlines the usage fine. Okay. Okay, 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 okay. Anyways, trial balance, list of balances on the ledger accounts, and please remember this to check the arithmetical accuracy of the double entry bookkeeping. Okay. So this terms, the arithmetical accuracy of the double entry bookkeeping is something you should remember because it's probably going to be asked. Like it's almost always when there's a question about trial balance, you have to mention arithmetical accuracy of the double entry bookkeeping. Okay. Because that's 1 mark, easy 1 mark. Okay. Uh, yep. Trial balance is not a part of the double entry system, by the way. Like if you're recording anything in the trial balance, there is no double entry for it. You don't do like debit trial balance, credit this, no. Okay. You just record it. Trial balance is not really an official something. This is the trial balance format. The purpose is to where is arithmetical accuracy mentioned? Anyways, can help locating arithmetical errors, as you can see, arithmetical. Okay. However, the balancing is not proof that all the entries in the ledger accounts are completely free from errors because there are some errors that are not discovered by the trial balance. That is the problem. A trial balance is useful in preparing financial statements because if you have all of your balances together, it's very easy to prepare the financial statements. The preparation of a trial balance. So the first thing you do is balance the T accounts, balance the ledger accounts, and then you're gonna put all of the debit balances on the debit side of the trial balance and all of the credit balances on the credit side of the trial balance. And then if both sides are equal, then you're arithmetically okay. Let's have a look at an example. As you can see, some stuff is debited, some stuff is credited, but at the end, they're the same, okay? Here we go. We have what to debit and what to credit. So you could say Pearls was pretty much derived from here. So if we remove this and we remove this, then we get PEA. The reason I removed sales returns is because sales is here, so it's obvious that sales returns will be on the debit side. And then C for capital, C for credit, D for drawings, D for debit. So you get to the RLS part. Incomes is revenue, by the way. Okay. So yeah, you need to pretty much use this table, which is a little more detailed than the mnemonic itself, but that doesn't mean the mnemonic is kind of stupid. You can just understand the mnemonic and boom. So yeah, this table is how you prepare the trial balance. And as you can see, assets, so like cash is an asset, and land and equipment, this is asset. Okay, let's actually kind of classify these things, by the way. We have asset, bank overdraft, which basically means negative bank balance liability. Capital is capital, drawings is drawings. Asset, liability, asset. Purchases is purchases. Sales is sales. Sales returns is sales returns. Purchase returns. Expense, income. Let's just say income fine. And then it literally says expenses. Trade receivables asset, trade payables liability. Okay. Yep, it's pretty much the same thing. We add closing inventory, opening inventory in the trial balance. We do not. That's a very good question. Where is it? It's mentioned here. 1 second. probably mentioned here by an inexperienced bookkeeper. There you go, inventory. What is the inventory? Does it say that we don't have opening inventory? Uh, Preparation of a trial balance. Because I'm pretty sure it mentioned it. I know it mentioned it. Um, uh, oh, yep, there we go. Does not appear on the books when a trial balance is prepared, so cannot be included in a trial balance. Okay, if you don't understand what this means, basically you're preparing a trial balance at 31st December and you have not really calculated your inventory at that date, okay? So the closing inventory does not appear on the books. You might have calculated it, but you don't record for it because you record for your closing inventory at the end of the month or at the end of the period when you are, what's it, when you're preparing your inventory account and you're transferring it to the income statement and all of that stuff, okay? So you only have opening inventory and a trial balance. There's MCQ questions about this and stuff. Please don't forget it like I forgot it. Very humiliating. Okay, now let's have a look at errors. This is a bunch of boring stuff, to be honest. Hmm. Do you guys think I should go make noodles? Yeah, exactly. I should, right? Okay, okay. Then I guess I'll make noodles in the break. Okay. If the trial balance fails to balance, when a trial balance fails to balance, it's obvious that an error has been made somewhere. It could usually be a mathematical error, like that, and then different on credit than on debit, or making a single entry than a double entry, or entering a transaction twice on the same side, like on the debit side or on the credit side twice, which leads to an not balancing trial balance, which is uncool. But then sometimes the trial balance will balance, but it doesn't mean there is no errors, okay? Because there's some errors that will still come if your trial balance balances. One, two, three, four, five, six. In our syllabus, there is six. I'm not sure if there's more. Compensating errors is one of them. There's five more. Okay, so you have error of commission when a transaction. Yeah, I know. I just said five more, like it's one compensating and then five more. I said I don't know if there's anything more in maybe AS or A levels. Okay. Okay. Error of commission when a transaction is entered using the correct amount on the correct side, but in the wrong account of the same class. Okay. Does this make sense? It's very weirdly worded, but here's what happens. Okay, in the wrong account of the same class. Okay, meaning everything is correct, is the correct transaction. You recorded debit, credits correct, fine. But instead of writing it to customer A's account, you wrote it to customer B's account. Does that make sense? So that's an error of commission. Okay. Okay, so you have your customer A. Let's just call this customer A, and you have customer B. So when you mess up the customers or when you mess up, exactly. So maybe it's trade receivables, maybe it's trade payables, maybe it's an expense, maybe it's an income. Okay. So the same class, it's going to be assets, expense, liabilities, revenue, whatever, but it's going to be the wrong account. So maybe instead of rent expense, you debited rates expense. Okay. So there we go. That's an error of commission. Okay. Then you have error of principal. Error of principal is similar but different. It is where you have the wrong class as well. So for example, I receive money from a customer. Instead of crediting that customer's account, I credit my capital account. Boom. There we go. That's a crazy error, right? So that's an error of principle. Where is the wrong account, is the wrong class, everything is wrong. The amount and everything is correct, the side is correct, but the accounts are completely wrong. Okay. So like motor expense, which is an expense, debited to motor vehicles, which is an asset. So they're completely different things. That is error of principle. Yes, pretty much. Okay. So error of commission is when you mess up the account, but it's the same class. So like both are customers. Error of principle is when you mess up the account and it's literally messed up so bad nobody really wants to talk about it. Then you have error of complete reversal, which is pretty simple. Let's just say that when you draw goods, let's take this example, right? Taking cash drawings. What are you gonna do? You're supposed to debit drawings and credit cash, okay? But instead of doing that, you kind of flip it. Boom. You do credit drawings, debit cash. So this is kind of stupid, but it's kind of a very common error between students at the start because they mess up debits and credits. I was there. Don't worry about it. It's not something to be sad about, but it's not something to be proud of. Okay, just keep practicing. And then we have error of omission when you literally forget to record something in the books. And how this does not affect your trial balance is because there is no debit entry and there is no credit entry. So the total will still be equal. Then you have error of original entry or error of original entry. This is when the transaction or when you're recording the transaction in your books of prime entry, let's just say sales journal. In that place, you recorded it as the wrong amount. Okay, when an incorrect figure is first entered in the accounting records, the double entry will continue to use the incorrect figure because what happens? You have your business document. Let's say sales. You have your invoice. Okay. After that, you take the invoice and you make your. Oh my God, let's lock it. You take the invoice and you make your sales journal. Let's call it sales journal. And then from the sales journal, you make you go to your sales ledger. Oh my God. You have your customer accounts and you have your sales account and you have your income statement and everything. So it all comes from the sales journal. If you made an error in the sales journal itself, then all of this errors will just continue forward to everywhere. Okay. Then compensating errors is when you have two or more errors which cancel each other out. Purchase account understated by 100 and sales returns overstated by 100. So they kind of cancel each other out again. So like let's just say that yeah, let's just cancel each other out. There's not really much to say about it. And I'm surprised we finished this fast. I was expecting it to take more time. Now we move on to double entry bookkeeping part B. Now we discussed what the ledger is. We discussed what ledger accounts are. We didn't really discuss what ledgers we have. We have three ledgers. We have a sales ledger, we have a purchase ledger, and we have a general ledger, or you can say nominal ledger. Okay. So what is a ledger account? A ledger account is this, the T account. It can also be in the running balance account format, but we don't really have that. So let's not talk about it, right? Like we're not going to use that. Okay, so this is a ledger account. Fine. What is a ledger then? A ledger has ledger accounts. Boom. But which ledger has which types of accounts? Very simple. The sales ledger has the credit customers accounts. Okay. So you have your sales ledger, something like this. Okay. Inside your sales ledger, you have a bunch of accounts. It's gonna be what? It's gonna be a customer A, customer B. Okay. And then in your purchase ledger, pretty much the same thing. But what do you have? Instead of credit customers, by the way, remember, this will only be credit customers because if it's cash customers, then you're just going to record it in the cash book. Okay. You won't make an account for cash customers. How do you record a cash sale? You're going to debit sales and you're going to credit cash. Sorry, you're going to credit sales and you're going to debit cash. But then if you sell goods on credit, then you're going to debit the customer and you're going to credit sales. Okay. So before we are debiting cash, now we are debiting the customer. When we debit cash, we do not involve anything with the customer, so there is no customer account. Okay. So any account in the sales ledger or any customer account, a customer T account, is for credit customers. All right. Purchase ledger is for credit suppliers. Instead of having customer accounts, you're gonna have supplier accounts. So like all of your supplier accounts are gonna be inside this thing. Please remember that the sales account is not in the sales ledger, okay? The sales account is not in the sales ledger. The purchase account is not in the purchase ledger. They are in the nominal ledger, the general ledger. Everything else apart from your credit customers and credit suppliers goes in the nominal ledger, okay? This includes your sales account, your purchases account, your capital account, all of your assets, all of your liabilities. Okay, let's just answer that question real quick. Sales ledger, I just explained it, okay? You have a ledger where you have all your credit customer accounts. Sales journal is a book of prime entry, okay? It looks something like this, just a square. You have your dollar sign, you have some details and date here. Now, this thing is a book of prime entry, okay? When you sell goods on credit to a customer, you're gonna write their name here. So let's just say, boom, I sold goods to me. For how much? 2 million. Fine. This is the sales journal part. There's literally nothing else over here. If I gave myself a trade discount, fine, I'm gonna reduce the trade discount, okay? You're gonna just do like 5 million minus 3 million, that's trade discount. Okay. So this is it. That's the sales journal. There's nothing crazy about it. And from this is a book of prime entry. From this, you at the end of the month you do transfer to sales account. You have to, by the way, there's one mark for this. Transfer to sales account. Okay. 1 second. And then in your sales account, which is in the nominal ledger, by the way, you're gonna have what is this? You're gonna have all of your sales on the credit side. This is the credit side. This is the debit side. You're gonna have pretty much nothing on the debit side except for balancing, balance CD, balance BD stuff. And you're gonna have your customers or cash sales or anything in the sales account. Okay, do you understand? So sales ledger is individual customer T accounts. Sales account is all your sales summarized in one place. And then sales journal is the book of prime entry where you first enter your sales and then from there you go to your you transfer it to your sales account in the nominal ledger. So we have discussed the three ledgers. Let's go to the textbook part now. No problem, bro. No problem. No problem. 1,300. Yay, congratulations. Okay. Division of the ledger into specialist areas. We have one, two, three ledgers. And every single thing here, every single thing apart from your, customers, credit customer accounts and suppliers accounts come over here. And then you have cash books, which is your cash account and bank account. And then you have petty cash book, which is just cash and bank, but at a smaller scale. Okay. I already mentioned this. And yep, let's move on now. The two column cash book. Thanks, man. The two column cash book. Should we take a break? Hmm. Yeah. Okay, then let's take a 6, 7 minute break. I'm gonna drink water or something. Okay, break time. I'm not sleeping, bro. Don't worry. I should become a master tomorrow. Okay. Hmm. Oh man. Okay, guys, I just had a very big idea. What's the idea? Let me think. No, I am in university. I finished my IGCSE and then I went to university. I skipped A levels. Hey, bro, I'm 17, bro. What uncle, man? How old are you? Yup, I skipped A level because I'm very cool. I didn't do AS, I didn't do A levels, and I didn't do foundation. I went straight up to bachelor's in accounting and finance. For the pussy. I wanna make noodles, bro. Anyways, how I'm doing my bachelor's in accounting and finance. I'm from Pakistan. Pakistan's in the blood. But I live in Saudi Arabia. Right now, I'm standing and just I'm looking at the chat. Got bored and hungry. I should probably go drink a glass of water. Yes, let's go. Pakistan Zindabad. How are you allowed to skip A levels or foundation? Honestly, I was shocked as well. But basically, the university, if you did 8 subjects for IGCSE, I did 7 in May, June, and then I had to do one in October privately. So I entered university a little late. I could have entered earlier. But anyway, so I did 8 subjects, and then this university apparently accepts after IGCSE, which is very cool. And after I got in, I got to know that there's a few other universities that do that, though I never knew about them. But well, anyways, that's pretty cool. I got into a university right after IGCSE, and yeah, it's fine. Though like it's co-ed and like the people there are not really fun, like how it was in school. But there is some nice people. I'm singing. I think I'm getting thirsty. I should probably drink water. Hmm. Oh my God, no water. It is water. Hmm. You can skip A levels if you get good grades in A level. Yeah, I actually had fine grades, but how do you mean? Like, are you asking or are you telling? Because like I skipped with some nice okay-ish grades. That's pretty cool. I got 3 A star and then 3 A and then 1 B. Actually 4 A. 3 A. I did business accounting, English, business accounting, economics, English, Arabic, Islamiyat, computer science, maths. Is that all? How many is that? Business, accounting, economics, English, computer science, maths, Islamiyat. There's one more. What did I do? That's a good question. Maths, CS, Islamiyat, English, Arabic, and then business, accounting, economics. Yep, that's it. That's 8. I should drink water. Gulp, gulp, gulp. Hmm. Okay, I think I will go pray Zohar and then I will be back in like 2 minutes, like 5 minutes. And then I shall probably eat chocolate. No, bro, I wanted to. I thought I was gonna get a rank, and then I got hit by reality. And then I got to know that I got 79 in paper two, like so disappointing. Oh my God. And then I was kind of sad, but then it's still a very high A star, so that's kind of all right, I guess. This code is asking me if I'm a human, but I don't know how to do this captcha. Am I a human, guys? Drag the element on the bottom to see to the one that is most similar. Uh, okay, genuinely what? This is kind of okay. I think I know. Boom. There we go. Yep. Let's go. Yay. Okay. Anyways, back to topic. What you doubt? What? No, I actually got 79 in paper two, and then I got like 34 out of 35 in paper one. But like my paper two marks are still disappointing. Bro. I lost like 5 marks in petty cash book, because I wrote the wrong details. So when I'm teaching this, I'm gonna tell you guys about petty cash book. Yeah, 79 or 100. Oh, the grading is so bad. Like the examiner, I don't know what he had before his exam or who he fought with or something. Why does he have beef with me, bro? How did he deduct marks for petty cash book? It's very easy, bro. It's very easy to get an A star. Like I could get an A even if I got zero in paper one. With 79 marks is an A. For me, it was like for my exam. 79 marks is literally an A. 79 out of 143. That's like half marks, bro. Major 25. The threshold is like people get you think. What do you mean? It's just the highest people get. What do you mean? Well, people probably get full, but there's people who get full. The world ranks and stuff is full marks. Okay, guys, I should go play Zohar ki namaz and then I will continue this inshallah. Inshallah, you all get good marks, bro. Allah kamyab rakhe. All right, see you guys in a bit. Okay, I'm gonna disconnect from the world. Alright, guys, should we start? Can you guys hear me? Is everything clear? There are 13 people in audience. Okay, let's start. All right, then let's continue. We stopped at the two-column cash book. So we're gonna start with cash book now. So we have two types, or like two ways of the cash book. We have a two-column cash book and we have a three-column cash book. I'm pretty sure we're gonna talk about both over here. Yeah. Okay, long chapter. All right, we discuss ledgers. The two-column cash book chapter to explain how to separate accounts, a cash account and a bank account are maintained to record the movements of money because everything that has to do with money is either going to be cash or it's either going to be bank. Okay. It's common for these accounts to be moved from the ledger and shown in a separate book known as the cash book. So instead of putting them in your nominal ledger or your sales ledger or purchase ledger, you're going to put them in a separate book called the cash book. You're going to keep them separately because you want to know your money values and stuff. Like it's a different thing from your other stuff, all right? The rules of the double entry bookkeeping are still applied. Any money received is debited and any money paid is credited. Fine, yep, okay. The cash and bank account may appear side by side. They still keep their own identity and must be balanced separately. There's marks as well, of course. The cash book is part of the double entry system. It represents ledger accounts for both cash and bank, but it's also a book of prime entry. Okay, so cash book is both a ledger account for cash and bank and a book of prime entry because it's the place where the transactions should be recorded before being entered in the ledger. Okay. Now, in your cash book, we have contra entries. So, for example, you're a businessman and you have $20 million in your bank account, and then some customer comes and buys a Bugatti and pays in cash. So now you have $5 million cash, and that's a lot of cash. You don't really want to keep that much. So you put some cash into your bank. Okay. You put all 5 million, let's say. All right. So in that case, your cash is decreasing and your bank balance is increasing. So you're gonna have to make an entry within the cash book. This is gonna be called a contra entry. So you have surplus cash paid into the bank. Your cash is reducing. Okay, when you pay cash to the bank, your cash reduces. If your cash reduces, what do? You credit cash, right? And then your bank balance is increasing. So you're gonna debit bank and you're gonna credit cash by whatever amount. Okay. So on the debit side of your cash book in the bank column, you will write the value, and for the detail, you will write cash. And on the credit side of the cash book, like, do they have an example? Cash book. Control. You do not have an example. No. Well, oh yeah, that's the entry here. Okay. Uh, you're debiting your no, this is not. This is debiting cash. This is also debiting cash. Okay, whatever. I will just explain like this. Okay, anyways, so if your bank balance increases, you're gonna debit your bank account, meaning on the debit side of your cash book, you're gonna write the value under the bank column and you're gonna give the detail as cash. And then on the credit side of the cash book, under the cash column, you will write the value which shows that your cash is reducing. And for the detail, you will write bank because the money is going to bank. Okay. The opposite is for, the opposite is for the opposite. And cash book, oh, this is important, by the way. In addition to making payments by check, you can also pay by electronic means. Like how you can pay by card these days and digital transfer and that kind of stuff, right? So you have a credit transfer, instructing the bank to transfer the amount to the other person. Or you also have standing order and direct debit, which is basically automated payments. So like you tell the bank to automatically pay the rent at first of every month. So the bank is gonna pay the rent at the first of every month. And direct debit is when a person Do you have standing order and direct debit? Direct debit is when a person notifies the bank that the permission has been given for a named person to collect an amount directly from the bank account. So let's just say I give you, I issue a direct debit for you or something. So you can always take some money from my bank account, okay, to collect an amount from my bank account directly. Direct debits are used for recurring payments where amount dates vary because this gives the flexibility to the supplier, to the person who's taking the money. He can take it whenever he wants. Okay. When a person uses a debit, let's see, other popular means of payments are debit cards and credit cards. When a person uses a debit card, the money comes directly from the bank account. And when you use a credit card, the company pays the person, and then the card holder pays some later, and that kind of stuff. So credit card is even if you don't have money right now, you can pay, but then you're gonna have to pay later, of course. So these are the means of payment. Usually, you need to sometimes differentiate between standing order and direct debit. You could say that they have MCQ questions and stuff relating to this. It's kind of a important thing because it's kind of confusing as well. Okay, started business with a capital of 20,000, which she transferred into the bank account. Since we're talking about cash book, I won't really go into detail about other things. So when you're starting with a bank balance, your cash book, it's gonna increase, the balance will increase. So it's gonna increase by 20,000 and the reason will be capital. So you're gonna write capital and the bank column will increase by the, okay. Another example, let's just have a look at this. Withdrew 150 from the bank account for office use. So we're withdrawing $150 cash from the bank account. This is a contra entry. Let's look at how they're doing it. So we have our cash on the credit side, which shows, sorry, we have cash on the credit side, and the amount is in bank, which shows that bank is reducing, and the reason is cash. And your cash is increasing, as you can see, cash is debited, and the reason is bank. Well, we will. Control accounts is tomorrow's chapter, I guess. For now, if you're like in a hurry or something, you can just look at the things in the accounting chat and you're gonna find it. In the speedrun, I've done control accounts. I told you that yesterday as well, by the way. But we're gonna cover control accounts tomorrow, inshallah. Okay, as you can see right now, the bank balance after all of this stuff is $940. This is a positive bank balance. This is the amount we have in our bank currently. In case we have a negative bank balance, it's going to be called the bank overdraft. It's possible to have a negative bank balance. It's going to be shown on the credit side, of course, because it becomes a liability. The bank column will always, the cash column will always be a debit balance because you can't really have negative cash. Okay, you can have zero cash. You cannot have minus cash. So cash will never be on credit. It's not possible to have a credit balance on a cash account, but you can have a credit balance on a bank account. Maybe your bank allows the business to take a bank overdraft, which means that you can pay more than what was actually in the bank, but then you have to repay this. And usually interest, you have to pay interest because of while you're repaying it, you have to pay interest on it, which is not a good thing. But if you're in an emergency or something, it's useful. The bank account is balanced in the usual way, and the balance is brought down on the credit side because it's a bank overdraft, it's a negative balance, it's a liability. Okay, the business owes the bank, and it's a liability. As you can see over here, balance BD 1060. This is the bank's balance, and the cash is still a positive balance. Then you have a three-column cash book. This is the difference is that it's an extra column for cash discount. Cash discount is basically a small discount you give, like usually 2% or 3% or maybe like 5% at max, probably. It's a discount you give to your customers so that they are encouraged to pay earlier. Okay. So let's just say I sell goods to you and I sold goods on credit, and I'm like, pay me tomorrow and I'll give you a 5% discount. So now you have an incentive to pay early. You want to pay early. Why? Because you want to save money. Of course, you have a business, you're opening a shop or whatever. Of course, like everybody wants to save money. Okay. So you're going to pay early to save or to get this cash discount. Okay. Just a second. All right. It doesn't really have to be paid in cash for cash discount. Like maybe you were gonna go like, oh, it's cash discount. Maybe you have to pay in paper money. No, that's not the point. The point is that you pay now. Okay. In accounting terms or in business terms, paid cash doesn't mean actually paid cash. Okay. Like it's possible somebody gives you payment by card, but you're gonna call it cash because he paid it immediately. Okay. So the time decides it rather than how the account is paid. Cash discount is to encourage customers to pay their accounts promptly. The money is paid earlier, so it's available for use within the business. You're gonna receive less, but it's worth it because you can use the money quicker. You can maybe invest it again, or you can maybe hire an employer or whatever. You can make use of it. But if you don't have the money, then it's better than having lesser money than having no money. Okay. And then discount allowed is when you give your customers a cash discount, and discount received in is when you receive a cash discount from your suppliers. And fine. It's important to realize discount received. Yeah, exactly. When you receive discount, it doesn't mean that the supplier is giving you money. You're just paying him less money. Okay. About the double entry, we're gonna talk about it hopefully. Oh, well, let's just go for it. When an account is paid by is trade receivable and the discount is allowed. If you're allowing a discount, it's an expense. You're gonna debit the discount allowed. Ah man, you're gonna record it in the cash book until the discount allowed column goes it. Well, let's just continue. We're gonna go to it once we reach it. The discount columns in the cash book, though they are they must be the totals must be transferred to the double entry system. Exactly. I low-key don't agree with this. What do you mean are not part of the double entry system? You're literally transferring them to the they're gonna get transferred to the income statement and stuff. Well, anyways, like okay, whatever. I don't know what to say for this person. So you're gonna have to total the discount column, debit the discount allowed account. Why debit it? Because it's an expense account with the total of the discount allowed. This is the double entry for all individual credits in the account of debtors. So instead of writing an entry for every single discount, every single time you allowed a discount, you're just gonna total it and record it once in the nominal ledger. Is it because like it's an expense account goes in the nominal ledger, and then you're gonna credit for discount received. You're gonna credit the discount received account because it's a revenue account, it's an income account, and those have a credit balance. Trade discount must not be confused with cash discount. Trade discount is not recorded anywhere, and trade discount is simply a reduction in the price of goods when the goods are purchased. And the reason for a trade discount is to encourage buying in bulk. Okay, so if you buy one piece, I'll give you a price of $10. If you buy 200 pieces, I'll give you a price of $8. Okay, that's just an example. Now we have dishonored check. For example, you give a check to a supplier, and the supplier goes to the bank and goes like, "Oh, I have this check," but the bank says, "Nah, bro, go home." Okay. So the reason why this happens, the reason why the bank refuses to pay, is maybe because the person doesn't have enough money. Maybe there is an error in the check. What kind of errors are possible? Maybe there's no signature. Maybe there's no date. The amount in words and the amount in figures do not agree. These are just examples. Okay. So the main part is maybe an error in the check, or maybe you don't have enough money. If a check is dishonored, it is returned to the business that paid the check into the bank. The business must record the check by crediting the bank account, and debiting the debtor's account. Because whenever you issue a check, when I am a customer, okay, and I have to pay you as a supplier, I have to pay you a supplier, okay. So I'm gonna give you a check, and I'm gonna record it in my cash book that I paid you. I'm gonna credit my cash book because my bank balance is reducing, and I'm gonna debit your account, okay. Oh, this is when you're receiving a check. It is returned to the business that paid the check into the bank. Go ahead. Doesn't make sense. What? Am I just sleeping or something? Nobody was typing. Okay, goodbye. Oh. Well, anyways, if a check received that is not paid by the bank because of some error. I don't get you. Yeah, exactly. That is a dishonest check. W definition, I guess. Okay, so if you have a dishonor check, when you pay a check over here, let's just look at this example. When you pay someone money, you're gonna record it as on the credit side because your bank balance is reducing. And then when the check dishonors, when the check doesn't work, when you kind of get your money back, when they give the check back to you, in that case, you're gonna debit your bank account and you're gonna credit the customer account. Pretty much the opposite of what happened to kind of cancel out this entry. Okay. Now, since you have already recorded this entry, and like you're a professional accountant or something, you can't really cut this. Okay, you have to cancel it out. You can't remove it because that's going to remove the record of you paying it in the first place. So you need to record it on the debit side to kind of cancel out the effect. This 770 and this 770 will cancel out. All right, I hope that does make sense. And sometimes when you pay, uh, when you receive money, no wait, what am I saying? Oh, no. Anyways, the same thing. Okay, here you can see that the discount allowed. Wait, here's the cash book. Yeah, okay. This is the cash book with the discount columns. Okay, you can see that we total the discount allowed and we total the discount received. We have the total 36 and 135. Discount allowed is an expense, so it's going to be debited, because it's an expense account. And discount received is an income, so it's going to be credited to the discount received account. And later at the end of the year or something, you're going to transfer to the income statement. Though that's not really something we're going to be discussing right now, but yeah, you just good to know it, I guess. Moving on to petty cash books, it's pretty simple. Um, it just has one different system called the interest system. A petty cash book is used to record very low value payments, like for example, $20 or something. But different businesses consider different things as petty cash, right? Maybe Apple has anything below $1,000 as petty cash. Like it doesn't matter if it's $1,000 to Apple, right? But to a small supermarket, it does matter if it's $10 or if it's $2. Okay, yeah, different businesses will have different amounts for their petty cash. Okay. The petty cash has two purposes. It lists the transactions for transferring to ledger accounts, and it acts as a ledger account for petty cash transactions. So it is a ledger account as well, and it's a book of prime entry as well. It acts as a ledger account. It is not a ledger account. It's a book of prime entry. It's part of the okay. Never mind. What? Wow. It's both the same as cash book. It's a ledger account and a book of prime entry. Maintaining a petty cash book means you don't need to record the small payments individually in the cash book or the ledger. And this is a good thing because your cash book will be less crowded. Okay. And let's just say you're a very smart accountant who takes like $10,000 per transaction, won't have to record these small, tiny transactions. So it's probably going to save you some money as well. You can hire a new accountant or you can train your employee or something to, manage the petty cash book. As mentioned over here, the task of maintaining a petty cash book is given to a junior staff member who is given an amount of cash to act as a float from his fine, fine, fine. Yep, it provides training for the junior staff. When a member wishes to obtain some petty cash, so the person managing the petty cash book, if he wants more money for the petty cash book, like let's just say the month ended and he needs money, because like of course where is he gonna make the payments and stuff from, right? The petty cash payments. So he's gonna present the bro. Oh my God, this is rage baiting me. So apparently, I'm going crazy. I think. When a member of staff, so like anybody working in the company, wants some petty cash, he's gonna go to the person managing the petty cash book, and he's gonna give him a petty cash voucher, and that's gonna be like, for example, maybe cleaning. I want $10 for cleaning. So the petty cashier, the person managing the petty cash book, he's gonna be like, fine, here's your $10, and he's gonna keep that petty cash voucher with him. Okay, this is what is included in the petty cash voucher. The date, wait, is it? The date, signature, purpose, and yeah, fine. Then you have something called the interest system. This means that at the start of every month or every week or whatever, what the business decides it, at the start of every period, the business gives, like the main cash book gives the petty cash book some money. Okay. Payments are made out of this interest amount, and at the end of the period, the petty cash book is balanced, and you're gonna get enough money from the main cash book to equal the interest amount. Okay. So every period starts with the same amount of cash. This is just advantages of it. Now this is what a petty cash book looks like. You have the debit side and you have the credit side. This part is the debit side, the rest is all the credit side. One second, sorry. This part is the credit side, the rest is all the debit side. My God, this, there we go. Okay, a petty cash book is similar to a ledger account, but it has multiple analysis columns. Okay, we're gonna look into that. It's not really anything difficult. This is just the different categories. Okay, a column is used for each of these categories, and these are the analysis columns. Okay, now let's look at the preparation of a cash book. You start with the interest amount or the balance BD. In this case, you have a balance BD. The interest amount is 150, and at the first you had 150. So you're just going to balance BD. And then you have the date of all your expenses. Window cleaner, so you're going to pay $10. You're going to record it in the total paid. And then in which category does it come? It comes in cleaning. So you're going to record $10 in cleaning like that. Okay. But one thing, like the reason I lost marks in this part was because of the details. Here it says paid window cleaner. So you cannot write cleaned windows over here for the detail. You have to write window cleaner. I wrote like stuff like cleaned windows and I lost a mark. Okay. Bought pens and pencils. So you need to write pens and pencils. If I wrote stationery here, I lost a mark. Okay. Paid etching, the credit supply, you just have to write etching. Paid taxi fare, so you just have to write taxi fare. Like you need to copy the words exactly. Okay. Office cleaner, so you're gonna write office cleaner. Okay. If you do not, you lose a mark. Like, it's stupid, honestly, but it's just what it is. Okay. So don't lose a mark. And then this is just totaling all of the columns. There is one mark for totaling all of the columns, by the way. And there's one mark for dates. And there's marks for all of this, I think, all of the details. And then there's mark for balancing. As you can see, first you total it, and the total paid is 115, which is, you get from 40 plus 11 plus 12 plus 52. Or you can, do it this way as well. Both give you the same value. Now you have the total paid and the interest amount at the start, and the amount you had is 150. So the balance CD is going to be 35. And then for the interest amount, do not write interest amount or interest restored or anything. You need to write cash, because cash is where the the amount is coming from. Okay, cash or bank depending on the question. And the amount is 115 because after 115 you equal to the interest amount. And then this is all the individual accounts, all the expense accounts and stuff. As you can see, it's going to be petty cash. It's all double entry. Okay. Let's do a quick question. How much was given to the petty cashier to restore the interest? Let's kind of, okay, I want you guys to answer this. Come on, guys. Can somebody answer question number one? I don't think anybody's talking. Okay, anyways, the monthly interest is 120. So the amount's 37. All right, let's have a look. So we have 120, 12 plus 31 plus 8 plus 43. This is the amount we paid, and then we're gonna add whatever we receive. So let's do this. 120, 12 plus 31 plus 8 plus 33 minus 11. What do you guys think? Is it 37 or is it 83 or is it like 120 minus 83, which is 37? Are you sure it's 83? Yep. Does everybody agree? The answer is 83 because whatever amount you spend is the amount you need back to restore the interest, right? So you spend this much and then you get this much back. So the total amount you kind of the net amount you spent or something is 83. If you get 83 back, you're gonna get back to 120. Okay? Yep. Pretty cool, right? Okay, then let's move on to section two. I think I will kind of stop the recording and then I'll start another one. All right, so we're going to start with section two now. We have business documents, and then we have one more chapter for this books of file entry, and then we're going to get to section three, I think. Well, anyways, it's this chapter is kind of boring, but let's go through it. Okay, so we have a few business documents. We have invoice, debit note, credit note, statement of account, check, and receipt. Some have to do with suppliers, some have to do with customers. Let's go through it. The accounting records in a business are made by the business documents. And from these business documents, you make the books of entry, like the journals and stuff, and then you make your ledgers and stuff, and then you make your trial balance, and then you make your final accounts. Okay, so the first one we have is an invoice. It's a document issued by the supplier of goods on credit only, because if you're paying on cash, you don't need an invoice showing the details of the goods you bought. Okay, so if you buy goods from me, then I'm gonna give you an invoice. Okay, so the supplier, the business that sells the goods, is gonna issue the invoice to the customer, the purchaser. Okay, every business has its own style of invoice, but they all contain these details, the date, the address of the customer and supplier, and the details of the goods. Okay. Trade discount is a reduction in the price of goods. The rate increases according to the quantity purchased, meaning the more you purchase, the more trade discount you get. It's to encourage customers to buy in bulk. The supplier will allow trade discount, and this will be shown in the invoice. Okay. As we mentioned earlier, cash discount and trade discount are different. Cash discount is for prompt payments, and trade discount is for buying in bulk. And trade discount is shown as a reduction on the invoice. Cash discount is not shown on the invoice. It's only mentioned in the invoice like a term. Okay, so it tells you that pay within this much time and you will get a discount. But all right, bro, have a good day. But we cannot really say that we cannot give the discount in the invoice because the person has not paid yet. Okay, so we don't know if he's gonna get the discount or not. So as you can see over here, 2.5% cash discount if paid by May 31st. We cannot deduct the discount yet because he did not pay yet. Okay, 20% trade discount because he bought a good quantity, a huge amount. And this is, by the way, 450.0, I guess. I'm pretty sure it was. Anyways, okay, yeah, so that's the credit note. You can see there's details about the product over here, and then there is the address of the customer, address of the supplier, and then it's an invoice, invoice number, the date, all of that stuff. Okay. Invoice is always issued by the supplier. Okay. For the supplier, he's going to call it a sales invoice. For the customer, he's going to call it a purchase invoice. The customer receives the original invoice and uses it to record the purchase of goods. The supplier keeps a copy and uses it to record the sales on credit. Okay. So you make an invoice, you give it to the customer, and you have a copy for yourself. So you can record it as, sales and stuff. All right. So that's it for the invoice. I'm pretty sure it's clear enough. I hope everybody understood it. If there's any questions, please ask. Moving on to debit note. If you receive goods and they're not good, like you buy something online and you don't like it, you can return it, right? But before you return it, you have to kind of tell the website that you want to return stuff, and then it's up to them if they accept it or not. Okay. So that's kind of what a debit note is. Okay. You get your goods and now you have to return them. So you issue a debit note. You kind of request a return. You tell the supplier, please take these goods. These are the problems. I don't want them. Maybe there's a different color. Maybe you charge too much or something. Okay. So for that reason, we're going to issue a debit note. A debit note is a document issued by a purchaser of goods to request a reduction in the invoice received. Now, how will the reduction take place? Maybe if you returned some goods, the invoice total value will be reduced, or maybe any other reason. Okay. The supplier must be informed of any shortages, overcharges, and faults. So if you have any problems, you're going to tell the supplier, right? Of course, because he's the person who gave you the goods. So each business has its own style of a debit note, but they all contain this information: the addresses of the supplier and customer, the date and details. When a price is included on a debit note, it's the price which was actually charged for the goods. Okay. So sometimes the question MCQs usually they're gonna tell you list price 400, and then they're gonna tell you trade discount 10%. So the final amount you will write is gonna be trade discount is gonna be the after the trade discount. Okay. List price means the price before the discount. And in your debit notes or credit notes or invoices or whatever, if you have trade discount, you will always record the value after the trade discount. Okay, after reducing trade discount. So as you can see here, the value is 48. They have reduced trade discount, and let's look at what reason they have for the reason is the wrong color supplied, and he's requesting the business to issue a credit note, okay, to accept this debit note and issue a credit note to like return the goods actually, okay. For debit note, there is no double entry or anything. There is no entry. It's just a request to the supplier. Where there has been an undercharge on an invoice, most businesses will issue an additional invoice. Okay, wow, this is surprising. I don't know who was the one asking this question. Um, who was the one asking this question? This her. Are you here? Um, right. Some businesses. 1 second, guys. If there's an undercharge, businesses, issue invoice, that's some businesses, and issue recovery. Okay, let's get back. This will be entered in the books of the supplier and customer in the same way as the original invoice file. Though usually like the understandable or the logical approach is to issue an invoice because if there's an undercharge, just issue an invoice. But I don't even know what they're gonna do with the debit note. Anyways, now when the customer requests a debit note and you actually accept the debit note, you return the goods. When the goods are returned, like officially returned or reported for where there has been an overcharge on an invoice, meaning Any reason. All of these are reasons for a debit note, by the way. Then the supplier may issue a credit note. It's their choice, by the way. It's like, you're the supplier, you own the goods. I mean, you're the one who decides. As with all documents, each business has its own style, but the addresses and the details and the date. As you can see, addresses and then the date, and then this is the details of the product, and they have giving the reason and stuff. So yeah. The customer receives the original credit note and records the purchases returns, and the supplier keeps a copy to record the sales returns. So when you have a credit note, that's when you record the purchase returns and sales returns. And when you have a debit note, you don't do anything. Okay, you just sit down. And then when a supplier issues a debit note to you, when the business issues a debit note to you, which usually doesn't happen in our syllabus and stuff. Usually it's just going to be an invoice, additional invoice if there's an overcharge. But if it does, then you're going to record it as an invoice, which it has never happened for me, by the way. Okay. Now you have a statement of account, which is the summary of the month for the customer. Okay. So it's going to have the address, the details, fine. Then it's going to have the financial or the accounting related details. Okay. So anything, the balance fee, you could say it's just a summary of their account, by the way. Okay. Statement of account. Yeah, pretty much that. So you have this opening balance. What is this? Okay. So you have the opening balance, you have all the invoices, credit notes, payments, cash discounts, everything that happened during the month. And then you have the closing balance. Okay. So we have our invoice and we have our credit note. We don't have any cash discount because, like, you know, he didn't pay, they didn't pay during time. And yep, this is the closing balance. No one makes an entry. This is just a reminder to the customer for the amount outstanding. So like when you send them a statement of account, they know that okay, I have to pay 360. Ah, that's a lot of money. This can be checked against the customer's own records also to make sure that there's no errors. Because like if you don't check with your customers often, maybe they're gonna be like, oh no, I don't owe you $200. I only owe you $2. What are you talking about? Like that. So it's not nice because it happens a lot in like today's world. You just tell the customer that they owe you this much, and they're gonna be like, no, no, no. So it's kind of annoying, right? So you have to do this stuff, be safe. Okay. Then you have check. A check is a written order to a bank to pay a stated sum or fine, whatever. It's pretty common. Like if you bought goods for credit and then you pay the supplier later, you give him a check, and then the supplier goes to the bank, gives the check to the bank, and then he gets the money. We all know what a check is, right? Okay. A check is a written order to pay to the bank to pay a sum of money to the person or business named on the order. Over here, the waving shed. But Sue and Sue is telling me, oh, 1 second. Sue and Sue sent a check. Yep, okay. So Sue and Sue is paying waving shed after the cash discount 351. And this is the check counterfoil. And this is the actual check. The supplier receives the check and the pay-in slip is completed when the check is paid into the bank, whatever. The counterfoil is used to make the entry into the cash book. So this is used by us, the customer, and this is by the supplier. And the customer gives the counterfoil, uses it to make the entry in their cash book and to record the discrepancies and stuff. Okay. And then you have a receipt. If you pay someone, they're gonna give you a receipt. They're gonna be like, okay, bro, you paid me. Thank you. Bye bye. Like that. Okay. It's pretty simple. It's just a written acknowledgement of money received. So you pay someone, they're gonna be like, okay, you paid me, and then they're gonna sign a paper, and then they're gonna be like, you paid me, and then they're gonna just cite some random details, maybe the receipt number and address, date, stuff, sign, whatever. And if you're paying with banks, you don't really need to have a receipt because the bank, is kind of verifying it enough that you have paid money because you can get the summary from the bank and that kind of stuff. You have a check as well. But if you sold goods on cash, it's usually a good thing to give a receipt or take a receipt so that there is no misunderstanding that, oh, you didn't pay. Okay, like that kind of stuff. Okay. Hopefully it makes sense. Let's go to books of prime entry. I feel like my uh, teaching is being nerfed. as we progress, which is not a good thing. We might have to take a short break later, but that is not coming anytime soon. We'll probably finish like 10 chapters and then we take a break. Okay, books of prime entry. So now we have six books of prime entry. Okay, and they're all pretty simple. They're very common. Wait, how many do we have again? One, two, three, four, five, six. Yeah, there's six books of prime entry, and then there's a petty cash book and cash book. Like there's six journals. There's eight books of prime entry. There's six of them are journals, and then two petty cash book. Cash book. We already discussed cash book and petty cash book. We already discussed sales journal, but fine, I'll go through it again. Sales return is pretty much the same thing. Okay, this is a good example. Okay, let's go with this. So this is our sales journal, and as you can see over here, you just have the date, name of the customers. All of these are customers, are credit customers, and then you have the invoice number. You don't really need to do this for our exam, by the way, invoice and folio. And then you have the amount, you total it, and you transfer to sales account. This is very important. Please do not forget this. Okay. As you can see over here, 510 trade after trade discount. So over here we record the final amount after the trade discount. Okay. And over here also 25% trade discount. So we record after the trade discount. Basically, we do not show the trade discount anywhere except for the invoice. Okay, and we already know how to show it in the invoice. It's just the terms, like it just says this much trade discount, and then like that. Anyways, the Living Shed issued a credit note because of the $10 overcharged. Let's see how they tackle this. We're gonna go to the sales return journal. So we have in the sales return journal, we have $10 for the Waving Shed issuing Jaffer and Company. So Jaffer and Company is our customer. We issue a credit note to them, meaning sales returns for how much? For $10. We, what other is there? Yeah, issue a credit note to so and so. For goods returns, list price $60. Now see here, it says list price $60. When we sold goods to who are these? So and so. When we sold goods to so and so, we gave them a 20% discount. So when we record the sales returns, we're gonna subtract 60. Like we're gonna take only 80% of 60 because of the 20% discount. And as you can see, that's 48. And then we transfer it to the sales returns account. But this is not the sales returns account. This is the sales ledger. This is the sales returns account in the nominal ledger. And as you can see, it shows something like this: credit sales for the month, returns for the month. Okay. So this reduces the number of entries uh, in the sales account. It makes it less crowded and that stuff. Okay. And then in your ledger, you can see you have all your credit customer T accounts. It shows how much each customer has paid and how much balance they have, and what happened in their account. So some guy bought goods and then sold them, returned them, and that stuff. Okay, very easy. Purchase journal, pretty much the same concept. Instead of customers, you just have suppliers, and then purchase return journal, everything's the same. Let's just have a look at something. Instead of issuing a credit note, you will now be receiving a credit note. Receiving a credit note, and the same concept, you're gonna reduce trade discount. So $60 minus trade discount gives you 48, and then 510 minus trade discount when you're purchasing goods gives you 408. Okay, so yeah, that's it. And then the same thing as ledgers. In ledgers, it's the account of your credit suppliers. As you can see over here, purchases are on the credit side because they're increasing the liability, increasing your trade payables. When you buy goods on credit, when you buy more goods on credit, you have to pay more to your suppliers. Okay, the purchase returns is on the debit side because it reduces your liability. It's reducing the amount you owe to your suppliers. Let's quickly move on. We already covered cash book and petty cash book, so it wasn't repeated. And we were supposed to take a break here, but let's just go. Let's finish this chapter as well. Now, this is a nice chapter, and it's honestly sad that there's only 8 people. Are you guys even alive, by the way? I need. Yep, that's good to know. Let's see. I need more than giving space when I realize it all. You guys want to continue? Do we start? Okay, let's go. So this is one second. Right. Financial statements part A, and then we have part B, the next chapter. It's quite an easy chapter. We're going to be introducing income statements and statement of financial position. We've talked a little bit on both of them. We know that income statement is to calculate profit for the year, and then we know that statement of financial position is to know the position of the business. All right. When a person is operating alone, is entitled to all profit, but will be responsible for any losses. When sales returns journal is transferred to sales returns account. Yep. So you have your sales returns journal, like so. You have your sales returns account, returns for the month from your sales return journal. And then in your individuality accounts of the customers, you can have like sales returns for each customer separately. So like Sue 48, so Sue 48 as you can see. All right. Now, the capital will be restricted to what the trader is able to invest. This is for like individual sole traders, okay? So this is just telling the disadvantages or the advantages of being a sole trader, okay? So the advantage is that fine, you can take all the profits, but you're also responsible for the losses. Decisions may be made quickly, but you don't you don't need to wait for others to accept your idea, and you don't need to argue and tell your idea is better and that kind of stuff, okay? It's just your choice. But you also don't have anybody to share the decision making or the workload with, because usually if there's someone else, it's helpful for you, right? You can talk and you can ask them and what to do and what to not do and stuff. The capital will also be restricted to whatever you are able to invest, and other forms of business like partnerships or companies, they have access to capital invested by other owners of the business, so they can grow faster than a sole trader, okay? So it's fine, it's good to be a sole trader, but there's also disadvantages. When you start a business, your aim is usually to make a profit, but how do you calculate how much profit you're making? So that is calculated in the financial statements, which you prepare at the end of the financial year. You have two parts. You have an income statement and you have a statement of financial position. In the income statement, you have two sections. You have a trading section and you have a profit and loss section. The trading section is up to the gross profit. It's where you calculate the gross profit. And the profit and loss section is where you calculate your final profit or the profit for the year. And they are part of the double entry system, okay? So anything you record in the income statement is part of the double entry system. It has debits and credits, okay? A statement of financial position is assets and liabilities. It is not part of the double entry system. The financial statements are prepared from a trial balance. Usually every item appears only once in such a financial statements. If it appears once in the income statement, it will not appear in the statement of financial position and vice versa. It's useful to place a tick against the items each time this is used, but if you're smart enough, you don't really need to do that. This is a trial balance. Let's classify what comes where. Revenue comes in the income statement, income statement, income statement, income statement, income statement, income statement. While opening inventory comes in the income statement and it's also an asset. But will opening inventory come in the balance sheet? It will not. Why? Because we prepare the balance sheet at the closing date. Opening inventory doesn't come there, Closing inventory does. And then discount received income statement, discount allowed income statement. By the way, this is income statement because like it's an expense. Sorry, because it's not an asset or a liability, okay? But this is an income statement because of cost of goods sold, all right? It's an asset, but it's still in the income statement. The rest is expenses and incomes and purchases and stuff, okay? This is an expense, so income statement, income statement, income statement. Okay. There you go. Now this is a non-current asset. It's an asset. It's something we own. This is also a non-current asset. This is an asset. This is a liability. This is asset, liability, capital, drawings. Okay. So, one second. Income statement, income statement. All the way here is our income statement, and then below is our statement of financial position. They have told us the closing inventory is 7,600. They did not include the closing inventory inside the trial balance because closing inventory is not part of the trial balance. That's why closing inventory will always be given as an as an additional information. During the year, Samir took goods costing 300 for his own use. No entries have been made in the accounting record. This will also be surprisingly part of the income statement and also be added to the drawing, so it's going to become 9,300. But this is actually something else, so let's kind of talk about it. Okay, the trading section is concerned with buying and selling. Anything that's related to trading, pretty much, given by the name. Hello there. And its purpose is to calculate the profit earned on the goods sold. Okay, all right. How do you calculate it? You start with the selling price or the total sales minus the cost of sales. Now, this is where we're getting kind of technical. Okay, so far we were just like looking at the basics and understanding things and stuff. Yeah, hello there. You guys have the same name. That's kind of surprising. Stolen bullet. Anyways, okay. So this is where we're getting out of technical. Before we were just discussing basics and stuff, and now we're gonna start with accounting part. Okay, so you could, yeah, we're pretty much starting accounting now because accounting is recording final making final accounts and financial statements and that stuff. Okay, so the selling price or the net sales, you could say net sales because it actually says that total sales minus any sales returns. So your net sales minus sales returns. Okay. Oh my God, what is this? Okay. Minus cost of goods sold. So cost of goods sold or the cost of sales is the total cost of the goods actually sold. This is not necessarily the cost of goods purchased during the year. Why not? Because you also have goods at the start of the year. You also have goods at the end of the year. Okay. So to calculate your cost of goods sold, you have opening inventory plus purchase minus closing inventory. Fine, most of us have this formula memorized, but we need to understand it as well, right? Because memorizing doesn't really get us to many places. So let's start with it. Um, if you want to calculate the cost of goods sold, what are the costs of selling the goods? First of all, is the cost of the good itself. You have to purchase the goods. So purchases is one thing. And so far, that's the only thing, right? We're not going into much detail, but we have opening inventory and closing inventory. So we add. This is not manufacturing business. We're just talking about sole trader businesses where like you buy goods and then you sell them. You don't really make them. So there is no cost of production or anything. Okay. All right. So we start with opening inventory, the amount we have at the start of the year. Okay. We add that. Now, why do we add this? We add this because this is the goods you might have sold during this year. Okay, if you have some goods at the start of the year and then you buy some more goods, you now have like let's say at the start of the year you had $10,000 of goods. Okay, you sold them and then you bought more goods and then you sold them and stuff. Okay, so these goods got sold, right? They got sold during this year, and then at the end of the year, like at the end, what are you asking me, or I'm kind of just explaining it, but then I'm struggling to put it into words. But I guess I've kind of managed. So opening inventory is added to purchases because actually because okay, let's just do it with an example. I'm so bad at explaining it words. All right, so let's just say at the start of the year you have $10,000 of goods and you sell them. You then buy more goods like $20,000 and then you sell like 18,000. Okay, and then at the end of the year you have $2,000 goods left. Okay. So whatever you have left at the end of the year, you did not sell that during the year, right? Because I mean, you could not sell it. That's why you have it left, right? So you have to subtract that. You have to subtract whatever you have remaining. You have to subtract your closing inventory because it was not sold. It's not part of your sales, okay? It's not part of your cost of sales as well. Bro, can you stop copying names? Oh, cool. There is no chemistry session, bro. I don't know. There's literally no chemistry session. Anyways, so yeah, that's the formula, and I hope you guys are understanding it a little bit at least. Okay, let's move on then. Now, when we talk about purchases, we have net purchases. So we start with purchase minus purchase returns because purchase returns are not really your purchases anymore, right? If you're returning them, they're not part of your cost. They're reducing your cost. So you subtract them. And then carriage inwards when you pay for delivery for the goods. And I mentioned before also when I was talking about carriage inwards that this is added to the cost of the product. Okay, so it's added to the cost of sales. So we add cost carriage inwards because it like without carriage inwards, our asset cannot be here, our goods cannot be here. So it's part of the cost, and then we subtract goods drawings because they are not any more purchases, they're not purchases anymore, like they're not increasing your cost of sales, they're reducing it, they're reducing your total purchases, so they're reducing your cost of sales as well. Okay, so you start with opening inventory plus opening inventory plus net purchases minus closing inventory, and this stuff is done in the trading section. You can prepare an income statement horizontally or vertically. The horizontal will have debit side and credit side, which is kind of nice for understanding double entry and transfer to income statements and stuff. And then the difference between the debit side is going to be equal to the gross profit. This is an example. On the credit side, we have sales because this increases our profit. Anything on the income statement on the credit side is something that increases the profit. Okay. And then on the debit side is what decreases the profit. Now, you guys might ask that, sales returns does not increase profit, it decreases profit. Yes, you're right. But we are recording sales return over here because we want to find net sales, okay? Similarly, closing inventory means it. Closing inventory increases profit. It's not something that's decreasing profit, okay? But we record it here because of cost of sales, okay? Cost of sales as a whole decreases profit. Net sales as a whole increases profit. So this is to calculate net sales. This is to calculate cost of goods sold. Okay, and that's why some things are on the debit side, even though they should be logically on the credit side. Okay, like goods for own use and anything. But if we're putting it on the wrong side, we're subtracting it. Okay, so that's kind of making it the same thing. And then you can see that this is 94,700. This is 65,200. So the remaining is the gross profit. Okay. Now we have gross profit CD. Later we're gonna do gross profit BD. We're going to bring it down, and then from then on we're going to subtract our expenses, and then we're going to get our profit for the year. Let's have a look. This is the same income statement in the vertical format. You start with sales, and then you subtract sales returns to get your net sales, and then you subtract cost of sales. You calculate it like this. You have three columns. The first column is for working, the second column is also for working, and the third column is for final values. In our exam, we will only have two columns. The first one is for working, and the second one is for the final values. You don't really need to put it all in two columns, but it just looks better. Okay, it's easy to read. You can even put every single thing in one column. It doesn't matter, you will get marks, but it won't really look good. Okay, so you subtract cost of goods sold, and then you remove and then you get your gross profit. Okay, then to find profit for the year, you have your gross profit, which we find from the trading section. And then you're going to add any other incomes you have, maybe rent receivable, maybe interest receivable, commission receivable, anything receivable and is an income. Okay, is an other income, which is like not mainly your sales, it's something apart from sales. And then you subtract all your expenses. Again, there's a horizontal and vertical method. And of course, if you have a profit, you can also have a loss. We start with the gross profit, as mentioned before, like we're going to do gross profit BD. And then any incomes, anything that increases the profit is going to come on the credit side. So incomes increase our profit. And then what reduces our profit? Expenses. So all our expenses come on the debit side because they're reducing our profit. So as you can see, and then we have our profit as the balancing figure. The total of this is 29,900, but then the remaining is 13,900. That is our profit. Now the same thing vertically is like this. We start with gross profit, we add our discount receipt, which is like other income, and then we subtract all our expenses. These are all our expenses, and then we get our profit. This is something you don't really need to do. So basically, you do profit from operations first, and then you subtract loan interest or any interest costs, any financial costs, and then you get to profit for the year. Okay. But for us, like you don't really need to do profit from operations. You can do loan interest and then you can get to profit for the year directly. It's the same thing. Okay, and then this is the entire income statement together. The two parts joined together. The first part is for gross profit, and then the second part is for your profit for the year. Okay, so one is called the trading account, and the second is called the what's it? I forgot. The profit and loss section. Okay, so sometimes the question will ask you to prepare a trading section of an income statement, which means that you only have to prepare it up to gross profit. Sometimes it's going to say profit and loss section. It's not even going to say income statement. This is going to say profit and loss account. So you have to know that it's talking about income statement. Okay, let's move on to this part over here. Transferring ledger account totals to the income statement. This is really important. Okay, because as we go into later chapters, this thing will like really become a pain in your head if you don't understand it. Okay, because when we go to depreciation or when we go to bad debts or when we go to expense accounts, chapter 11 today, then we're going to have to transfer the values to the income statement, which is honestly a little challenging if you don't know it. But worry not because I shall explain it right now. Okay, let's get right into it. Anything appearing in the income statement must have a double entry in another account. I already mentioned that. Okay. Anything credited to the income statement must be debited in the appropriate ledger because that's how double entry works. And vice versa, anything debited to the income statement will be credited to the appropriate ledger account. So tell me, guys, if purchases, or let's just look at the horizontal presentation, right? If discount allowed comes on the debit side of the income statement, then where will income statement come on the discount allowed account? Anybody, please. If discount allowed is on the debit side of the income statement, then where will income statement be on the discount allowed account? Come on, guys. Credit side. Okay, perfect. What about if I'm talking about property tax? If we have property tax will be credit. The income statement on the credit side. Why? Exactly. In the income statement, the property tax is being debited. So in property tax, income statement will be credited. You know, the opposite, right? Okay. What if we talk about discount receipt? If you have a discount receipt account in the income statement, it comes on the credit side. So yeah, perfectly debit side. Okay. And the value will be 400. Now, quick quiz. Tell me, in which ledger will discount received account be? In which ledger is discount received account, the T account? We have three ledgers. Nominal ledger. Okay. In which ledger will discount allowed be? Okay. What about wages? Wages. What about sales returns? Can nobody else answer? I'm pretty sure there's more than one person. Sales returns. In which ledger? We have three ledgers. We have sales ledger, we have purchase ledger, and we have nominal ledger. In which ledger does sales returns come? Come on. Every single thing comes in the nominal ledger, okay, except for customer accounts and purchase accounts. Sales returns, nominal ledger. Sales, nominal ledger. Purchases, nominal ledger. Inventory, nominal ledger. Expenses, nominal ledger. Assets, liabilities, expenses, incomes. Actually, not all assets, only like all assets except for customer accounts and all liabilities except for supplier accounts. But yeah, you get the point, right? So every single thing comes in the nominal ledger. Only customer accounts and supplier accounts go in the sales and purchase ledger. All right. So we understood that. If something's debited in the income statement, we're gonna credit it in its own account, okay? And we also looked at how it happens and stuff. We did examples and whatever. Now let's look at their way of saying it. So you have purchase account, you're gonna total it. Normally purchases are debited. On the income statement, in which side do purchases come? They come under cost of goods sold, right? They come on the debit side. They reduce the profit. This is the income statement. This is the credit side. This increases the profit. This decreases the profit. Purchases come on the debit side of the income statement, meaning in purchase account, income statement comes on the credit side. Easy. Another way to remember it. If an account has a normal positive debit balance, then income statement will come on the credit side. What about purchase returns account? It has a normal credit balance. Income statement comes on which side? The debit balance. Okay. What if you don't know debits and credits? Well, income statement comes on the opposite side of the total. The total is on the right side. The income statement will be on the left side. So there's multiple ways to understanding this, all right? And then for the inventory account, this is something kind of important, okay? Uh, all other items have similar transfers from the appropriate ledger, yes. Okay, inventory is a little different way of being transferred, okay? And gross profit and profit for the year are also transferred like through they're transferred within the income statement, okay? Like their double entry is balance CD, balance BD within the income statement. So, yeah. And then the entries for profit, inventory and profit for the year. Could you do a club after you explain this? Man, actually, I'm like going in a series. Okay, so clubs is gonna be for tomorrow. I'm doing 11 chapters today and then 11 chapters tomorrow. So tomorrow we're gonna do clubs. But if you want to do, like, if you want to go through it right now, then I can share you the link for the last time's session. Last year I hosted a session at the same time. So last year was one day before the exam. Today is a few more days before the exam. You can click on the link and then you can go to the speedrun session and hopefully you're going to find what you're looking for over there. All right, then let's continue. There are two entries for the inventory in the income statement. Why two? Because you have two inventories. You have opening inventory and you have closing inventory. The inventory account will have a debit balance representing the entry at the start of the year because, like, it's an asset. So, of course, it has a debit positive balance. And then at the start of the year. This is credited to the inventory account and transferred to the debit or the income statement. So this amount opening inventory is going to be credited to the income statement like normal, right? You're going to transfer to the income statement. So you're going to credit it and boom, transfer it, right? No worries, man. That's right. Like what you know that. You know, like that is. Okay. All right. The inventory at the end of the year. 1 second. There we go. So you're having a debit positive balance, and then to transfer it to the income statement, you credit the account and you debit the income statement with this. And we know that opening inventory comes on the debit side of the income statement, but closing inventory also comes on the debit side of the income statement. That should mean that uh, that closing inventory should be on the credit side of the inventory account, but it's not. It's on the debit side of the inventory account. But like I said, it's supposed to be on the credit side, but because of the cost of goods sold formula, where is it? Vertical, horizontal, over here. But because of the cost of goods sold formula, we put closing inventory over here on the debit side. And to kind of balance the effect of it being on the debit side, we subtract it. Okay. So that's the reasoning behind it. And they've also explained it over here. But let's go step by step. The inventory at the end of the year, which is the closing inventory, is shown as a deduction from the debit entries in the income statement, which is equal to a credit entry. Now you see the closing inventory in the income statement, it's debited, but it's shown it's shown like it's with a minus. Okay, so it's reducing the debit side, which means that it's equal to being a credit inventory. Okay, if it's credit, then it's going to be debited in the inventory account. Okay, so you debit the inventory account because you're reducing, the debit side of the income statement. I guess, like, I hope it makes sense. It does to me, but it's kind of like a long story, you could say. Anyways, so you have the closing inventory like this, and you're gonna have the closing date, of course, because anytime you transfer to the income statement, you will always have the closing date because you prepare the income statement at the end of the year, and then the value will be the closing inventory value mentioned to us by the question. All right, and then for profit, it's gonna appear as in the capital account. You know that profit is on the debit side in the income statement, as we just mentioned. Like it's a balancing figure, right? Where is it? Over here, as you can see, it's a balancing figure. It's on the debit side of the income statement. So where is it on the credit side? The credit side of what? Well, it's on the credit side of your capital account, okay? Because it increases your capital, okay? And then drawings are on the debit side because they decrease your capital. A loss for the year will be on the debit side of the capital account because it reduces the capital. And instead of saying capital, look at what they're saying. They're saying the amount the business owes the owner. So that's a nice, way to say it. And then the total of drawings is transferred to the capital account, as you can see over here. And yep, drawings account is also like this. You have the total drawings. So you have 9,000 cash drawings and 300 purchase drawings or goods drawings. But instead of saying goods drawings, you're gonna have purchases over here because it's from the purchases account, okay? And then you're gonna credit it to the capital account. You're transferring it at the end of the year, as you can see, and you can see that it's transferred over here on the debit side of the capital account. Now, so far we mentioned the income statement of a trading business. Okay, so they have goods, they have inventory, they have cost of goods sold, and they have gross profit. But a service business, one which does not buy and sell goods, they do not need uh, they do not need any cost of goods sold or any inventory or any gross profit. Okay, so examples of a service business is like maybe an accountancy firm or an insurance company, a travel agent, hairdresser, anything like that, hotels and whatever. These businesses still need to prepare financial statements, but they don't prepare trading account because there is no goods bought or sold. Okay. So only the profit and loss section is prepared. So you start with revenue and then you subtract all expenses. And this is literally as easy as accounting can get. Okay. You start with anything you earn, and then you subtract anything you lose. Boom, that's it. Profit for the year. This is probably worth like 5 marks usually, but sometimes, like if they really want to annoy you and stuff, they're gonna give you a bunch of adjustments, and they're gonna make it like maybe 17 marks, 15 marks. So something that would be worth 5 marks becomes 15 marks after adjustments. And adjustments is, by the way, chapter 11, which we will hopefully cover today. And then this is the same thing in the vertical format. You start with anything you earn. This is the total amount we earn, or you could say our revenue. And then we subtract all our expenses, and then we have profit from operations. We do loan interest. You don't really need to do this part. You can do directly profit for the year as well by including loan interest with your other expenses. Let's have a look at this. Somebody please answer this question, and I will eat the chocolate now. I'm waiting for you guys to answer. Question number 3 and the question number 2. Come on, guys. 5 members. Are you serious? Everybody's beating, bro. We started at like what? I forgot. A. Okay, let me read the question. Okay, anyways. A fashion retailer did not record goods costing $500. What was the effect on this error? Uh, did not record goods costing. Okay, I think I cannot eat the chocolate. I should answer this question now. So, goods costing $500. This is drawings of goods. This is reduced from your purchases. And if you do not record this, your purchases are overstated. If your purchases are overstated, your cost of goods sold are, I think I should just write it down. So not recording this leads to purchases being overstated, which leads to cost of goods sold being overstated. Exactly. Okay, anyways, that's what I'm talking about this. Oh no, wait. But yeah, go for it. Continue. I'm just gonna continue explaining. Cost of goods sold and then increasing cost of goods sold leads to reduced gross profit, and reduced gross profit leads to reduced profit for the year. So both of these become understated. The correct answer is B. What about A? Oh, sorry, what about question number 2? And this chocolate looks yummy. I should provide the following information. So this looks easy. Um, just tell me the values you're using. Thank you, man. Mm, is someone answering? Okay, let's check. Okay, that looks correct. Oh, all right. Let's move on to this, but let's take a 2 minute break so I can finish my chocolate. Hmm. Okay, should we continue? अच्छा एक मिनट हाँ Second. Guys, what should I do? It's kind of lunchtime because my brother is here too. And then like, no. What can we do? Should we take a 15 minutes or 20 minutes break or something? Okay. Man, I don't feel like there should be more people, man. How was it so far? Like, is it fine so far? Was it good? Really? That's good to know. Okay, then I'm gonna see you guys in like 15 minutes or something actually. Oh wow, I'm surprised. That's pretty cool. All right then, I'm mute and stuff. Okay, we're gonna take a 15-minute break and then we're gonna continue. And I'm gonna stop this recording and then I'm gonna continue the next one. Just okay, that's it for the recording. All right, peace, guys. Have a good break. I wonder if the rest of the people are actually active or they're just like sitting. Oh, Shawarma is there as well. Wow. Oh, man, a lot of people said they would join, but I guess they're relying on the recording. That when you're transferring things to the income statement, when something is on the debit side, where is it? Yep, anything, where is it? Anything debited to the income statement will be credited to the appropriate ledger account and vice versa, right? Okay. So when we look at our income statement, the horizontal format, which is over here, we can see that inventory comes on the debit side. Okay, inventory comes on the debit side, opening inventory comes on the debit side, and closing inventory also comes on the debit side. Okay, now if it's coming on the debit side of the income statement, if opening inventory is coming on the debit side of the income statement, then where will income statement come on the account of inventory? What do you guys think? Maybe try rejoining because most people can. Credit side, exactly. So if it's debited, if income statement is being debited, then the inventory account will be credited with income statement. Okay. And we're going to use the last day of the month because you're making the income statement at the last day. Okay. And this is going to be the opening inventory. Now for closing inventory, by the way, before this, you have the balance BD, the opening inventory value, and now it totals. Now, as for closing inventory, it's also on the debit side, but it says less. So like it's subtracting. So it's kind of the opposite of the debit side while being on the debit side, meaning it's equivalent to being a credit value. Okay. And that is confirmed over here. Where is it? Down here. When something is deducted from a debit item, this is equal to a credit entry. So a debit entry is required in the ledger. Okay. So in our case over here, where is it? Yep. The closing inventory is debited to the income statement, but it's subtracted, which means that it's equivalent to being on the credit side. Okay, logically, it should be on the credit side. But since the cost of goods sold formula itself is on the debit side, we have it all, together. Okay, so that's why we're gonna have it on the closing inventory will be on the debit side of the inventory account, and it's gonna be, logically, you can think that it's on the credit side of the income statement, but in reality, it's the debit side of the income statement. Okay, does that make sense, Mustafa? Should we move on to the next chapter? Accounting is easy, bro. Should we move on though? Is it clear? I suppose that's a yes. So let's continue. Did he leave or what? Okay. Okay, so financial statements are prepared at the end of the year. We have income statement and statement of financial position. Statement of financial position shows our assets and liabilities, and assets are explain what. Explain. Hmm. Is it your first time? Like, do you have your exam this Wednesday? Oh. When is your exam? Like your board exam? October. Okay. Well, asset is anything the business owns. Okay. So anything you own, for example, a car or anything like that. All right. I guess I'll reshare my screen because some people are experiencing difficulties. I hope it's better now. All right. So assets are what we own and liabilities are what we owe others. It's also mentioned here what we own and what is owing to. And then liabilities is what the business owes. Okay. The assets show how the resources are being used, and the liabilities or capital show where they come from. Okay. Now we have two types of assets. We have non-current assets. In there, we have tangible non-current assets, and we also have intangible non-current assets. Tangible non-current assets are your normal non-current assets, like machinery and everything, maybe buildings, land, machinery, motor vehicles, and stuff. And then when you're making your statement of financial position, you arrange your non-current assets in the increasing order of liquidity. So the most illiquid assets, so like the most permanent assets, come the first, and then the more liquid assets. So like you're less likely to sell your land and buildings. You're more likely to sell your motor vehicles. You usually sell your motor vehicles after maybe 5 years, like that, right? Because like if it's too old, you're gonna sell it. Okay. So yep, this is the order of liquidity. But again, this doesn't really matter. It's just a nicer way to do it. Okay. We are doing statement of financial position, so don't worry. And if you absolutely don't know anything about the chapters before this, then I'd suggest that you watch the previous videos, or you can just click on my profile and you're gonna, see my channel linked in my profile, and you can just click on that and the YouTube channel, and then you can. Non-current assets is anything we have for over a year, more than 1 year. It's something we do not intend to sell, and its value cannot be changed to you during the year. Okay, it's something we buy, but we don't want to sell it. We don't buy it to sell it. We buy it to use it. Okay, intangible non-current assets are long-term assets, which is like, non-current assets, which do not have material substance. You can't really see them or touch them, but they belong to the business and, they have a value. So like you do record for them, you do account them and stuff. But for IGCSE, we don't really need to do anything. We just need to know that they exist. Okay. Examples are not goodwill, brand names, and trademarks. So these are intangible non-current assets. You just need to know that. Okay. You don't really need to know much about it. Goodwill is the amount by which the value of a business as a whole exceeds the value of the separate assets and liabilities. They don't really ask the definition. All you need to know mainly is that goodwill is an intangible asset, okay? Intangible non-current asset. Now moving on to current assets, these are short-term assets. They arise from normal trading activities. For example, our cash, bank, trade receivables, inventory. All of these are short-term assets. Their values always change, okay? These are assets, maybe cash or like they are cash, literally cash, or they can be turned into cash easily. So if you have trade receivables, you can turn it into cash. You just have to go to your customer and you'll be like, give me money, go. Okay. It's also usual for these to be arranged in increasing order of liquidity. Basically, all assets should be arranged in increasing order of liquidity. So the most liquid assets, so this like most liquid means like closest to cash, will be at the last. So cash itself is the last. Then you have bank, then you have trade receivables and inventory. Inventory is before trade receivables because inventory is like two steps, You have to first sell the inventory, then you have to collect money from your customers. Okay. But again, this is just formatting, it doesn't contain marks. Now for liabilities, we have three types. One is capital. Why is capital a liability? We don't really need to. You don't need to, but it just looks good. For example, if the examiner is checking, the mark scheme has it arranged this way, okay? So it's going to be easier for the examiner to check. And it's just going to make you look cool. That's it. You don't need to follow it. It's just cooler too. Okay. So in liabilities, we have three types. One is the same as the assets, non-current liabilities, current liabilities. But then we have capital as well. Why is capital a liability? Why do we need to mention capital as a liability? It's because the owner's investment or whatever the owner invested into the business is also something the business owes the owner. Okay. It's the amount owed by the business to the owner. So that's why, you include capital within liabilities. And then the sum of this is going to be equal to your assets. Non-current liabilities are amounts owed by the business which are not due for repayment within the next 12 months. Basically, a long-term liability, you do not have to pay this back within the next 12 months. Okay. And then current liabilities are those which you have to pay within the next 12 months. And they're like, they happen normally, like trade payables. If you buy goods on credit, you're going to have a current liability. You're going to have to pay it within 12 months. Okay. Bank overdraft as well. It's something that happens normally. And then similar to the income statement, you can prepare a horizontal and vertical statement of financial position as well. The horizontal one is going to have assets on the debit side. It's going to follow the accounting equation, and then liabilities and capital on the credit side. Okay. And there's literally nothing much about it. This is your assets. And then there's your capital, opening capital plus profit for the year minus drawings. Basically, your capital account summarized into, like this. And it's pretty simple. And then you have your non-current liabilities, and then they must total. So that's in the statement of financial position. It's fairly easy. Okay. And this is it in the vertical form. You have your assets first, non-current assets, then you have your current assets, you total them, and then you have your liabilities and your capital. Liabilities, you just write them. You could say that the main part or the most difficult or technical part in this is the capital part because you actually have to use your brain here. You have to take the opening capital, you have to add anything that increases the capital, which is profit for the year, and then subtract anything that decreases the capital, which is drawings, right? And that gets you to your final capital. And then you add your non-current liabilities and current liabilities, which gets you to the total of capital and liabilities. And this is equal to the total of assets, which means that your statement of financial position is balanced and that it's correct. Okay. If it's not balanced, then you're making an error and make sure you check everything. Let's do this question quickly. Dwayne's assets and liabilities on 29 September were as follows. Invested 10,000 additional capital. What is the capital after this transaction? So we can calculate the capital easily. Assets plus liabilities equals to capital. In second, sorry, was the accounting equation. Assets equals to liabilities plus capital, and then we can just, do algebra, and then assets minus liabilities equals to capital. This is our only liability. So can somebody find the answer for me? Like, I want you guys to tell me the answer. I've given a bunch of hints. on, guys. Nobody answering? Let's check. 49,500 plus 9050 minus 7450 plus 8150 plus 750 plus 10,000. Yep, that looks correct. Let's actually confirm. This is chapter 9, question 3. Oh my god. If it was 6, chapter 11. 3, 2 is C, 3 is B, 4 is B. 2 is C. Yeah, perfect. Okay. 3 is B. Okay. A trader took cash from the business for personal use. What effect would this have on the financial statements? When you take cash, of course, your cash reduces. And then when you take cash for personal use, it does not affect profit because assets do not affect your profit. Okay. Is it still lagging? By the way, if it was goods drawings, if it was drawings of goods, then it would affect your profit. Okay. All right. Let's move on to the next chapter now. Chapter 10. This chapter is honestly a pain. And as you can see, I've estimated it's going to take a bunch of time. And that, this is what I considered to be a bit challenging, these three. So we have a few accounting principles. We have 10 of them, which we're going to do now. And then we have the accounting standards. We have 4 of them. Basically, every single accounting statement or anything you do in accounting has to follow these 4. Every company has to follow them. And then we have capital expenditure and revenue expenditure, somewhere where almost every single one of us loses marks because of how, I don't know, there's literally like, it's just weird, okay? Okay. And then we have capital receipts, revenue receipts. This is pretty simple. And then effect on profit of incorrect treatment. Honestly, this is fun, but it's kind of difficult if you do not know what capital expenditure and revenue expenditure is. So you need to have a clear understanding of those. And then we are gonna go for inventory valuation, which is also a fun topic. It's nice. For real, exactly. It's literally that. Okay. So let's start with this. Accounting has developed a number of rules, must be applied by everyone recording financial information. If everyone made their own rules, it's going to be impossible to understand and compare. And the accounting principles must be applied by every business, which must be applied by every business. I explained in this chapter. Now, if a business does not apply these principles, it's not like the government's gonna come for them and then shut their business down or something. It's just that they're not really doing it the right way. All right. It also describes how capital and revenue expenditure, revenue receipts should be recorded. Fine. All business follow. Okay, sure. Sure. Okay. All right. Accounting principles, sometimes referred to. You have honestly, I don't know. Just like some people say, it's good to divide 20 minutes per question, but it doesn't really matter. Like maybe the first question is cash book and you're really good at it, so you finish it in 5 minutes. And then maybe there's an incomplete records question and you're really struggling at it, so you spend 30 minutes. Yeah, it is supposed to be recorded. Hopefully, they're recording it. I don't know. Last time they said they're gonna record it, it wasn't really recorded. But yeah, I'm hoping that it is recorded. I don't know how though. Probably is. I'm recording it myself though for myself. I'll probably upload it on YouTube or something maybe. Well, anyways, so accounting principles or accounting concepts or accounting conventions or whatever are rules which sets down how financial activities of a business are recorded, and they're an acceptable method by which the rule is applied. Fine, whatever, whatever. Okay, we're just gonna like we're not gonna go into super much detail, okay, because I don't want to spend a lot of time on this, but I'll still explain stuff enough for everybody to understand. And then if there's any question, please like do not hesitate to ask. Okay. So let's start. The business entity principle. This means that the owner of the business is separate from the business itself. Okay. Now, what does this have to do with the accounting records? Like, why are we studying this in accounting? This is because, for example, if I am the owner and my house is, of course, not part of my business, like it's my house, and if I have to pay my water bills or electricity bills, I take money from the business and then I record it as electricity expense. This is not allowed. This is wrong. Why? Because this, when I say electricity expense, it means that it's the business's expense, but it's not the business's expense. It's my expense. Okay. So I should take the money out, record it as drawings, and then use it however I want it. Okay. If you buy a car for yourself, you cannot record it as a car for the business. If I buy a Bugatti for myself, it's not that I'm going to record it as a non-current asset in the business. It's not the business's car. It's my car. Okay. So let's just read the textbook definition. The business entity principle, also known as the accounting entity, means that the business is treated as being completely separate from the owner. The personal assets or the personal spending do not appear in the accounting records of the business. The accounting records the accounting records relate only to the business and record the assets of the business because like you're literally making accounting records for the business. Why would you put your personal stuff in there? Okay. And if you put your personal stuff in there, you're kind of overstating and understating things. Like if I am putting my electricity bills for the business, it's like saying that the business has lesser profit, but in reality, the business is making a profit. It's making a good amount of profit. I'm just putting all of my expenses there. So that's not a nice way, you know. Like when I'm comparing with other businesses, who do not put their electricity bills part of their accounting records, then I'm gonna feel like I'm a very bad I'm doing very bad in my business and stuff, you know. So it's gonna make comparison and all of that stuff not work properly, which is not a good thing, at least not for us students, because we have to get marks, you know. Other stuff doesn't really matter, right? We need marks. Okay, right. Everything is recorded from the viewpoint of the business. All right. If there is a transaction connecting both, uh, then it's supposed to be recorded the right way. Okay, so like if you're taking something else, then you record it as drawing. If you're introducing something, then you record it as capital. Okay, as I mentioned. So that's the first principle, business entity. I'm pretty sure it's clear, right? No questions. If there's any question, just ask. Then we have consistency. This is only applies to places where you actually have a choice in accounting. Where, for example, you have depreciation, right? There's several ways to calculate depreciation. There's three in our syllabus, and you can choose whichever you want as a business. It's your choice. You own the business. But then don't go like for the first year I'm taking this method, for the second year I'm taking that method, for the third year I'm taking that method. You have to stay consistent, okay? Yeah, like you have to stay consistent everywhere, even in accounting, which I'm struggling with. Anyways, so yeah, means that accounting methods must be used consistently from one accounting period to the next. Used consistently. If this is not done, a comparison is going to be impossible because, like, in the first year you're using straight line methods, the second year you're using revaluation. Like, what are you even doing, bro? Okay, so comparison is not going to be accurate. And if you have a good reason, then sure, do it. But like, you need to kind of, adjust for it and stuff. This, like, yeah. I don't think they're going into much detail. Maybe it's something like AS or something. But yeah, for us, we just need to know that it is possible. We just shouldn't do it, okay? If it's necessary, and if you really have to, maybe like, I don't know, the market changed or something, the world changed, or maybe you went to Mars, I don't really know, whatever. But yeah. And then you have duality. This is the easiest one. It's literally double entry. We did this in chapter 2, double entry bookkeeping, you know. So it tells that every single transaction should be recorded twice. That's it. How every transaction has two aspects, a giving and receiving. And yeah, means that every transaction is recorded twice, once on the debit and once on the credit. Then you have going concern. This is kind of something you should remember. Don't forget it. It means that, and this one's also kind of probably the most technical one. I don't know. Because like yeah, when questions come for this, like relating to this, it's kind of difficult to understand it. Okay. Anyways, the accounting records of a business are always maintained on the basis of assumed continuity. Meaning like you assume that you will continue your business, you will continue operating, you're not stopping anytime soon, you're not going to close anytime soon. Okay. Now, what does this have to do with our accounting records? Like, fine, the business is operating forever. So what? What do I do? It means that the non-current assets shown in the statement of financial position will appear at their book value. Okay. You know how when we write non-current assets, we write cost minus accumulated depreciation. equals net book value. We record our assets at net book value. Why? Because of the going concern principle. Because we assume that our business will continue operating. It has no intention to close. Okay. But what if it actually has an intention to close? And then this is the book value is one example. And then the second example is lower inventory being valued at lower of cost and net realizable value. But if it is expected that the business will really stop in the future, with some questions, if it is expected, they will explicitly say like they're going to be like the business will stop, alas. Okay, then in that case, you're going to value these as non-current assets at their expected sales value. Why? Because those matter more. Okay, those are more realistic at this point. Like right now, we're trying to close our business. We don't really care about what the value is for us. We care about what the value is in the market, like what it's going to get us. Okay, because we're going to planning to shut down the business. So when you're planning to close the business and you have it, like you're actually planning it, in the near future, then you record your assets at the expected sales value. But normally, if the question doesn't say anything, then you're going to record the assets at the net book value. Okay. So yeah, like once a question came for this in MCQ or something, and then I was like stuck. How much time do you have for question? What do you mean five, bro? We have five questions. We don't have five time per question. How much time do we have per question? And are you the Alan? Wow, you are the Alan. How's it going, bro? How studies? Silence, silence. Okay, anyways, let's get back. Historic cost. That's good to know. Historic cost principle requires that all assets and expenses are initially recorded in the ledger accounts at their actual cost. For example, I buy a car, especially I buy a big car. Okay, I buy a car, and then what happens is that the next day something happens to the car showrooms, and then every single car just dies. Okay, so now my car is worth a lot. Okay, but that doesn't mean that in my accounting records I'm gonna record it as a lot. I'm just gonna record it as what I bought it. Okay, that's the historic cost principle. You record things that what it cost you, not the market price. Okay. So, yep, it's closely linked to the money measurement principle. Cost is a known fact and can be verified. Fine. Okay. They didn't really explain, give more details. Wow. You record it. Look, when you buy an asset, let's just say I buy an iPhone today. Okay, I buy it for whatever. I just buy something. I buy product A for $10,000. Okay, and the next day something happens and the value of order A falls to $8,000. Maybe something economic happens. Okay, I don't know. The world changes really fast these days, right? So the value of the asset changes in the market, but my asset is still going to be recorded at 10,000. Why? Because I bought it at 10,000. Okay, it doesn't matter what the world says. It matters what matters is what when you bought it, something like that. You get it? You get it? You get it? Pretty sure you get it. Okay, just remember that assets and expenses are going to be recorded at the actual cost, what it cost you. Okay, it has to be ending. Who to trust? Trust nobody. Trust yourself. Okay, bro, just trust the textbook, bro. Actually, don't trust the textbook. It's kind of stupid. Never mind, it's not stupid. It's fine. It's okay. Yes, trust Alan. Alan Salan. His exam is in May 2026, and he's got. Yes, for sure. He's a very smart guy, probably. Okay, anyways, matching principle. Now, matching principle is also referred to as accruals principle. When we're going to do chapter 11, this principle is going to come in handy. It's going to be very related to whatever we're going to be doing. It just tells us that anything you record has to be related to the year you're recording it, okay? Bro, okay, man, it's not accruals principle. Today it's matching principle, all right? Anyways, yep. Okay, this is an extension of the realization fine, whatever. It just says that when you like you only record expenses that relate to this year. Okay, let's just say that I paid expense for 200. No, 200 is a wrong. I paid expense for the next 2 years. Okay, like let's just say I paid rent for the next 2 years in advance.
In today's income statement, will I write all of that rent? Like I just say, I paid rent 200 years in advance, maybe 200,000. Okay. In today's income statement, will I write 200,000 as my expense? 200,000 is the expense for this year. It's not. 200,000 is the expense for the next and the next year. Okay. Exactly. So that is what it means. Okay. It doesn't matter when you pay the money. It matters when you pay the money for. Okay. Like you get it? Like if I'm paying the money today, but I'm paying it for the next 25 years, then it's going to be recorded in the income statement of the next 25 years. Okay. It's not going to be recorded today. Yes. I see. What if I forget? Bro, then don't forget. Like it's that simple, man. What do you mean, what if I forget? It's not that difficult. Why is it recorded in the income statement? Dude, if you have an expense, where will you record it? If you have an income, where will you record it? Exactly. It comes in the income statement. And then when you record it, you don't record. Yeah, sure, fine, bro. I'm talking about final accounts. Are you guys being slow on purpose? Anyways, the figures shown in an income statement must relate to the period of time covered by that statement. So you know how at the start of the income statement it says that income statement for the year ended 45 December 2026. So that means that you have to show expenses for that year only. Okay, you cannot give expenses for 1st January 2027 or something. Okay, yeah, all right. Okay, and then we have materiality principle. By the way, please, matching principle is important, okay? Matching principle, going concern, and business entity is also kind of important. Like it's simple, so you don't really have to worry much. Then materiality principle is basically anything that's very cheap, don't record it. For example, if I buy a pencil and I buy it for like $0.2, okay, very expensive pencil. I record it as a non-current asset. Yep. And then I put it in a statement of financial position. And then I do depreciation straight line method. 0.1% a year, actually 10% a year. But don't you think that's kind of overkill? Like this much depreciation and recorded as a non-current asset and so much for something as low as a pencil? Like it doesn't really matter, does it? Exactly. Count it as an expense. Even though it is an asset, fine, but it's so cheap. Like you don't really need to count it as an asset and then, put depreciation and stuff. Bro, I don't know, man. Maybe you just care about it, okay? Maybe you do weekly depreciation. Come on. We bunch it up and record it as one shot. Yeah, exactly. Like you just, bro, it can cost as much as it wants to, okay? There's no limit, man. There's no limits to life. You can do whatever you want. You can get a world rank, you can get an A star. You can get 100, 1 out of 100, probably. Just write the exam okay? Okay, anyways. $100 doesn't have to be recorded. Look here, it says here, if I'm a very, very big company, right, and I'm like super duper millionaire or something, right? And for me, $0.2 is like nothing, okay, fine. But then I'm so rich that even $200 is nothing, okay? So it depends on the business, exactly. Like if the business is very broke, then even $0.2 means something to it, and maybe he's gonna record it as a non-current asset and do depreciation and stuff. But like you have to be in the next level of broke for that, okay? If the business is a big, big business, exactly. See, Alan said it, bro. Alan is smart, bro. Alan, Alan. Okay, anyways, you're welcome, you're welcome. Let me just claim that 1 second. There we go. There we go. All right, perfect. Anyways, a pocket calculator is a non-current asset, yes, but it's like you don't really need to charge depreciation of on it because if you charge depreciation, you're gonna have to pay your accountant to calculate depreciation for that and stuff. The calculator maybe cost you $5, but paying your accountant is gonna cost you like $15 just for calculating the depreciation. So it's not worth it. It's like a waste of time and waste of money and waste of every single thing you have in your life. Okay, it would be regarded as an office expense instead of a non-current asset. Okay. But remember, what is material for one business may not be so for another business. If someone is like, if a business is really large, then a small laptop is probably worth nothing. Okay, but for a small business, a small laptop is still worth an all current asset. Okay, so yep. small expenses in one account, maybe general expenses and stuff, rather than having individual pencil account, you're gonna have a general expense account, okay? Because having a pencil account and then, yeah, exactly. That's the W definition. Amazing. It just depends. In your notes, you don't have to give textbook definitions. Want it make comparison with other business? Oh, it's so small. And also, why are you comparing with big companies if you're a small firm? Okay, so you have to compare with firms within your own level, right? Why would you compare with Apple when you're a supermarket? Think about it, man. Level two. Exactly, bro. Yeah, it's just fine, exactly. You can compare. Nobody's stopping you. But just remember that they're just like their sales is gonna be 10 million, right? So $100 doesn't really make a difference, you know? Okay, money measurement principle means that only information which can be expressed in terms of money will be recorded in the accounting records. Can you say that my employees have $200 mindset or $200 creativity? Well, you can, but I can't. Okay, in accounting, you can't. It doesn't. Oh my God. Okay, well, anyways, being serious though, you cannot really say my customers are $1,000 loyal. My customers are $200 million loyal customers, or you cannot say that my workplace is $100 clean. It won't, bro. They're just gonna laugh at you and they're gonna go away. They're gonna go to some other supplier. Think about it. Okay, so you only the information that can be recorded as in monetary terms is going to be recorded in your accounting records. Okay, so for example, the morale of the workforce or the effectiveness of a good manager or the benefits of a staff training course all play an important role in the part in the success of a business, but they will not appear in the. Yeah, depreciation is a non-monetary expense. Nobody pays money or nobody gives money. Do you lose any money or gain any money when you have depreciation? Don't say okay, say thank you. I will take the rep. Yes, there we go. No, depreciation is not monetary, it's non-monetary. No, that's business, bro. That's business. Okay, anyways. Then we have prudence, one of the most important principles. It's very cool. It basically means that whatever you record it nicely. Don't overstate or understate things. Okay. Don't overstate your assets and expenses. Don't understate your liabilities and incomes. Okay. Don't overstate or understate anything. Okay. That's prudence. Realization principle. Oh my God, this is rage bait. Okay. What's that, bro? No, accounting is easy. Just a few things are rage bait. Like they're absolutely dumb. I don't know. Well, this is kind of important. Anyways, realization principle. It means that you realize how life is, and then you realize how life is. Anyways, it means that revenue is only regarded as being earned when the legal title, okay, legal title to goods pass from the seller to the buyer. Now, when does the legal title pass? I think it's when the invoice is placed. When the goods change hands. Until it has actually been earned. Revenue is only regarded as being earned when the legal title passes from the seller to the buyer, who has then a liability to pay for those goods. So when you give a customer an invoice, he has a liability on you. He has to pay money for those goods. Uh, Honestly, wait a second. Let me Google this. Can you make an example using shawarma? Not really, man. I am also not hungry. Exactly. I have to think though. Anyways, first I'm gonna Google this. What exactly? Uh, when when does when does legal title legal title of goods pass from seller to buyer? Let's see what Google Search says. Uh, is it by invoice or by physically goods delivered? Because I feel like when the invoice is issued, the legal title passes. But then the question, the textbook also says that. Oh, what is this, man? Anyway, so surprisingly, okay, well, so the goods will only be actually sold and profit will only be regarded as earned when you give the goods to the customer. Okay, when the goods go to the customer when they're delivered, that's when profit is gonna be, profited. You get me? You know, yeah. Yamamoto window. Teach relying on Google. Bro, I'm not relying on Google. I'm just confirming. That's the point. Oh my God, Alan, you're so rude. Transactions are realized only when goods are delivered with the services given. Yup, TY. Thank you for that. Are we cooked? We're not cooked, bro. We're not cooked. Trust. Hmm. Invoice. What is invoice? Brother, when is your exam? October 27, right? Hmm. Hey, I'm gonna ban you. Yes, thank you. A mod came to save me. Okay, let's continue. Let's continue. Guys, we should not. We should not. Hey, what you do? I will attack you. Okay, very unrelated note. Studying accounting. Yeah, everybody has accounting this Wednesday, bro. Accruals. Okay. Oh yeah, guys, we have a very good chapter left. Hello, stomata, tomata. We have chapter 11 left. It's very annoying. It's very big, very ajib. Okay, international accounting standards. Oh my God, accruals is good. It's fun. It's not formats, beta. It's understanding. You have to understand it. Formats. Yeah, exactly. Just understand the logic. I think he wants to get banned. Okay. Stomata. Okay. Anyways, guys. International accounting standards are ensure that. Oh, by the way, is this session recorded? Is this session being recorded? Stomata. Wait, how do you guys know it's not? You guys are just, I don't know, yapping, bro. No, you're not. You're like you're meow 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 meow. Yeah, I am, but who said I'm gonna send my recording? I don't know. I know, right? I'm so funny. Thank you. Dang, bro. Okay, finish. Yeah, they're gonna have to pay me like $500 million, and then I might consider sharing it. Okay, international accounting standards ensure that financial statements are prepared using the same rules and guidelines internationally. Okay, and you don't really need to know every single accounting standards. That's for AS. Okay, like they have to save something for AS as well. We have the first one. We have four: comparability, relevance, reliability, understandability. The information must be comparable with other businesses. The information must be relevant to the performance and stuff, to the relevant to the users. One second, where is it? About the business financial performance at 4555. It is important that the information is available in time. So you need information to be available in time. That's one. It has to be comparable, can be compared, has to be available in time, relevant to the user of financial statements. This is kind of relevance. Reliability means it should not really have errors. You should be able to rely on it. It should have correct, no bias and that kind of stuff. And then understandability means that it should be not so difficult. It should be kind of simple, and but it should not be so simple that you kind of remove the accounting part from it and make it, I don't know. Wow. Okay, guys, come on, get back to the topic. I'm actually teaching something here. We are at chapter 10. You missed 10 chapters. Thank you for saying that, Tomato. Relationship principle means that if you love someone, they're gonna love you back. Realization principle. It's basically that you only record sales the moment the goods are actually delivered. Okay, back to understandability. Oh my god. Back to understandability. The accounting information, the financial statements you have, they should be easy enough for people to understand, and you have to assume that the users of the financial statements have a reasonable knowledge of business and economic activities. Remember this word, bro, reasonable knowledge, okay? This is going to come in MCQs. It's usually the 34 or 35th MCQ, and it's about one of these four, okay? It almost always comes. Okay, moving on to capital expenditure and revenue expenditure, and then we're going to do inventory valuation, and I think we're going to take a 5 minutes break so I can, I don't know, look at the sky or something. What if it doesn't come? Yeah. Any questions, by the way? Any questions so far for chapter for the principles and the relevance and the wealth accounting standards, inshallah. Okay. Okay, let's have a look here. Um, okay. You guys say something? Example of the prudence. Prudence is basically okay. Prudence means to not overstate or understate assets or liabilities or expenses or anything. Okay. Write everything at its correct value. Do not overstate, understate stuff. Yep, exactly. That's such a perfect definition. That's the exact word I said. Amazing. No problem. No, that's not. This has been going on since 11 o'clock. It's 3 o'clock now, so 4 hours, I think. 11 to 1, 2, 3. No, it's 3 hours. I'm not sure. I can't count. 11 to 1, 1 to 2, 11 to 12, 11 to 12, 12 to 1, 12, 1 to 2, 11 to 12 to 1 to 3. Uh, you guys get it, right? Yeah, 4.5 hours. Yep, exactly. Smart people. Okay, anyways, back to the topic, capital and revenue expenditure and receipts. So, capital expenditure is when you do expenditure on capital, and then revenue expenditure is when you do expenditure on revenue. It's not that easy. I hope it was that easy. We all hope it was that easy. Anyways, so capital expenditure is money spent on purchasing, improving, or extending non-current assets. Okay, remember this part, non-current assets. It's like long-term purchases, and this includes all legal costs incurred in the purchase of non-current assets, cost of carriage, and cost of the delivery, basically, and cost of installing. Okay, so if you buy machinery, the legal cost, maybe the legal insurance or legal fees or whatever on that, or the delivery fees or the installing of machinery, all of these are going to be part of the cost, and they're going to be counted in capital expenditure. The difference between bookkeeping and accounting, you can watch the previous session of May June 2025. It's recorded and it's advanced in accounting. Okay. Now, when you have capital expenditure, guys, I think I'll just turn off the chat because at this point, there's not anything useful going on here, right? What happened was the question. Is insurance also included in capital expenditure? Insurance, honestly, I was confused with that myself because once the question came and I added insurance, I remember insurance was included, but then if I think it's like if it's the first time insurance, then it counts. But then if it's the second time, it doesn't. Is insurance expenditure? It's a revenue expenditure according to this. Yeah, I thought so. Though I feel like there was one case where it was, yeah, then you just put it as Then you just put it as revenue expenditure. All right. Anyways, these costs will appear as non-current assets in the statement of financial position. Basically, all of your capital expenditure is part of the non-current asset. Okay. So even if the asset costs 100,000 and then you add all of these, it becomes 110,000. The final value is 110,000. Okay. And that should be counted as your non-current asset and you put depreciation on the total value. Okay. It's not going to be charged as an expense because the benefit is for several years. It's not only for this year. Okay. And you're going to do depreciation on this. And yeah, that's it. And then revenue expenditure is the money spent on your normal activities. You know, you're paying money for whatever expenses and stuff you have, basically every single thing. Okay. And then you have capital receipt when you receive money from anything other than your normal trading activities. Okay. Normal trading activities is like selling and buying goods or, any other incomes. Maybe you have rent receivable, insurance receivable, commission receivable, all of that. Okay. So examples of this are maybe you're adding additional capital, or maybe you have loans and the receipt of loans and proceeds of sale of a non-current asset. So if you sell a non-current asset, that's uh, if you sell a non-current asset and you get money, that's capital receipt. Okay, because it's money you receive from anything, from something as what are you guys even talking about, bro? Anyways, because if it's money you receive from other than your normal trading activities. Again, remember a capital receipt is not part of the income statement because it's not your daily income kind of thing. Okay, it's gonna come separately and it's gonna be different and all. The profit only is gonna be part of the income statement, or the profit on sale or the loss on sale, like that. Okay. Stomata, just remove Yamato Endo and Adam did not really study in. Please, I request you. Or just time them out so they can maybe stay in the session and not actually have. Okay, revenue receipt is your normal receipts, anything you're receiving from sales and all of that stuff. So your normal trading activities. These include revenue from sale of goods, fees from clients, anything, rent received, commission received, discount received, interest received. Okay, basically your every single revenue you have apart from all of this unique stuff. Okay, and then yep, hopefully this is clear. The problem with this is not the concept, it's the questions. Okay, the questions come in the various ways possible, and it's kind of difficult to get all marks in them. Okay. Okay, now for inventory valuation, we're gonna value inventory at lower of cost and net realizable value. Why? Because of the prudence principle. Okay, you don't want to overstate your inventory because it's gonna cause the both profit and the assets to be overstated. Why profit overstated? Because like if you're overstating your closing inventory, your cost of goods sold becomes understated, and then your gross profit increases, and then your profit for the year increases. So because of one single mistake, a lot of stuff happens. Okay, so don't make a single mistake. The cost of inventory is the actual purchase price plus any additional cost. Usually, we only have carriage inwards, okay, included incurred in bringing the inventory to its present position. So if you buy goods for like maybe $10 per $13 per unit, and then you have to pay $2 for delivery cost, which is cash or carriage inwards, then the total cost of each unit will be $15. Okay, the net realizable value is estimated selling price minus any selling expense. Okay, minus cost of basically bringing the good back to insellable condition. Okay, guys, for real, can you guys leave if you're not studying? I don't really care about anybody who's here and not really studying. Like if you're here for yapping, then go in some other chat. Okay, I'm literally being for real here. Hmm. Okay, anyways. All right. So that's how inventory is valued. It's going to be valued at lower of cost and net realizable value. And look, under normal cases, the net realizable value will always be higher. Sorry, will always be higher than the cost. The cost will be lower. But sometimes the product is going to be damaged, or maybe like it got burnt or something, it got destroyed or whatever. In that case, there is no demand for such type of goods or whatever, or maybe it's damaged. Then the net realizable value will be lower than the cost. And let's look at this example over here. We have good type A, 94 units, cost is 20 and net realizable value is 18. Okay, the cost does not include the carriage and loss of $1, meaning the new cost after you include the $1 is 21 and 16. What else? It will cost zero point 0.5 per unit to bring type A goods into a sellable condition. How many of them are damaged? 0.5 per unit to bring type A into sellable condition. Okay. Well, anyway, so the cost is the actual cost of the product is gonna be your cost plus purchase price plus carriage inwards. And then for net realizable value, it's gonna be selling estimated selling price minus any selling expense. Okay. So 12 units and will only be sold at $10 per unit. So we have 12 units at $10. We value that separately. We have 26 units, the remaining after we subtract 12. And then lower of cost and net realizable value, we choose 16. I 15 on the hill. Oh, only good A, my bad. I put it for both goods. Okay, so this is $15 and we choose at $15, 26 units. This is 26 units. The 12 units is gonna be at $10 because that's the net realizable value. The questions will be in this step, though. They will be. They're like weird questions. They're more than this. This is just two lines. There's more. There's usually more, yeah. Okay, anyways, so over here, we have the net realizable value, which is the estimated selling price. And then for the selling expense, we have zero point 0.5, right? So we do 18 minus zero point 0.5, which gives us 17.5 as our net realizable value. And I'm pretty sure everybody knows it. 17.5 is lower than 18. So we choose 17.5, multiply it by 94 units, we get 1645. And then we have 12 units at $10 because, this one. And then we have 26 units at $15 because that's the lower of cost and net realizable value for type B. And then we total this, and that gives us the closing inventory, which we will use in our, statement of financial position and closing, and income statement and everything. Okay. Now, it's really important to understand the effect of what? Inventory, right? Okay. What are they doing now? Overstating, understating? No, no, no. What's the question? Oh, okay. Undervalue the closing inventory by $50. Now you see, because of this one thing, there's this whole huge table, and it's like so important and so big. No questions, right? Okay. All right. So I think I should go through it. How much time? We have spent an hour on this chapter so far, right? Hmm. We have spent an hour. Okay, I'm gonna just go like through some of them, and then you guys can figure out the rest if you want to. Gross profit for the year ended 31st December 2007. Okay, so he was it for the year 31st December 2007. He discovered he overvalued his closing inventory by $50. If your closing inventory is overstated, your cost of goods sold will be understated, which will lead to your gross profit being overstated. Okay, and that's why it is, you know, overstated. This is correct. Okay. Then for the next one, gross profit for the year ending 31st December 2008, which is the next year. So this means that the opening inventory is overstated because if it's the closing inventory for this year, it's going to become the opening inventory for the next year. Okay. So opening inventory is overstated, which will lead to cost of goods sold being overstated, which will lead to gross profit being understated. And yep. And then for the profit for the year, If your gross profit is overstated, your profit for the year will also be overstated automatically. And then same for here. If your gross profit is understated, your profit for the year will be understated as well. Then your capital. If your gross profit is overstated, your profit for the year is overstated, your capital will also be overstated. The same thing. Actually, what? That's crazy. Why? Capital at 31st December 2008. Opening inventory. Understated. What is this, bro? Can somebody help? 1 second. Let me put my charger on. Oh, this is kind of weird. Okay, I'm back. Maybe because it affects assets. 1 second, I'll actually just focus and try to understand. So the question is that closing inventory was overvalued by $50, and over here it becomes opening inventory. Opening inventory overstated by $50, which leads to cost of goods sold, gross profit reducing. This is kind of weird, bro. Okay. The total current assets, fine, fine, fine. Right, what? Overstating the profit. 2007, we want 2008. Ooh, look at this. This is crazy. Overvaluing inventory for 31st December will affect the financial statements. Fine. Understating the profit. Yeah, yeah, exactly. Did I not mention that? Okay, anyways. Understating the profit for the year means that the balance of the capital account will have been corrected. Oh my God. Well, this is you can call compensating error. So you see how the profit was understated here. 1 second, let's actually look at it like this. The profit for the year is overstated here, and then it's understated here, right? So this the at the opening it's overstated. Exactly. At the opening it's overstated, and then the capital is overstated. But then when it's understated, the capital is understated, and it was overstated before, so it kind of balances out now. Pretty stupid. Like, oh, this is what rage bait is. Okay. And then you have current assets, opening in, what's it, closing inventory is overstated, so current assets are overstated. And then later the same thing happens that, the error cancels out. The total of the current assets later will not be affected. I know, right? This is why I started this because these kind of tables are always like this. It's when you have a table, just lock in. Okay, like let's look at this now. Ha, ha, ha. At the end of the financial year on June, bro, you're just smart, man. Okay, anyways, at the end of the financial year. Oh, I wanted to record how much time I spent in this. I forgot to. Anyways, at the end of the financial year, 30 June discovered that he had undervalued the closing inventory, which means that if you understated your closing inventory is understated, will lead to cost of goods sold being what? Overstated or understated? Underrated. It's gonna be overstated, bro. One sec. It is understated. Let's have a look at our answers. Question number 6, part C. We are on chapter 9, question 6. ESQ chapter. No, we are on chapter 10 now. Right? Chapter 10. Yep, 6, part C. Understated, overstated, no effect. What the hell? Understated, overstated, why no effect? Are you stupid? Really fake. Chat, why no effect? Oh, bro, this is oh. Anyways, it's because it's 2006. I thought it was 2007, and the error gets cancelled out like before, like we did last time. If you don't understand it, then let's kind of explain it a little bit more. On 30 June 2006, which means that it is the closing inventory here. And then on 30 June 2007, it becomes the opening inventory. If it was understated last time, this time it's going to become overstated. Yep. And then that's going to kind of cancel the effect, okay? Cancel the error. Not really, because like it's one mark, and then if you get a lot of other marks, it's you don't really lose the A star. Okay, then let's take a 5 minute break over here, and then we're gonna start chapter 11 in the next part. Anyways, how many people are attending? 16 people. That's surprising. I've got a video. I've got a video. Check it out. Um, dun, 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 dun. Guys, what color is your Bugatti? What color is your Bugatti? Oh my god, I am so bored. Actually, let's go to YouTube. Oh my god, it is 3:27 already. Guys, your brain is smarter than you think. That's what my YouTube recommendation is. Uh, is he going to finish the entire syllabus? I'm gonna finish the 11 chapters tomorrow. The rest 11 chapters tomorrow. No problem. Oi, IDKK Pache, don't take my rap. Anyways, from where I can make practice for topical past papers. Don't say exam mate, bro. I exist here. Use this, bro. Use this. 6 p.m. Yeah, man. We started 11 a.m. and it's 3:30 now. I think I'm gonna do one hour more now. Cause like the next chapter is gonna take 1 hour. No, I didn't really update it for like after 2025 or something. Because like man, too lazy. But yeah. Someone is someone want to study this syllabus with me till November session? Uh, I can teach you. I can give you tuitions. I'm a very cool guy. I give tuitions. Oh, you want tuitions? No problem, I guess. Yeah, I can. I give tuitions as well. But like, you want them? I can teach. Yeah, sure. I'm explaining computer codes tomorrow. But if you want tuitions, then sure, I can do it. No, cash only. Card may be fine. Card works as well, but I prefer card. I don't know. When is today's recording going live? Last months. Actually, till where will you do today? We have to finish 11, chapter 11. And computer code is the best to practice after doing ratios. Not really. It's really simple. There's nothing difficult in computer code. Till where will you do today? Sure, a second. Let me just put that here. What do CEOs actually do? My YouTube recommendations are amazing, bro. Like, oh my god. I applied 4 logical tests to every major manager. It says the greatest double agent ever, fake Nazi. Oh my god. Peak content. Okay, I should view my channel. And then I shall, let me just copy this, paste it here. Hmm. You can confirm your say 5 minute break finished. Okay, do you guys want to continue? I'm gonna do 12 tomorrow. I have to kind of, I've been going on for 11 o'clock, right? So it's kind of been a bunch of hours, you know. Please wait. Bro, you guys aren't even studying, just shut up. Only stolen Brovelet is studying, like, I don't know, amazing person. Are you a guy or, I don't know. Anyways, Vasan kaun hai bhai? What's that PFP, bro? That's weird. Yes, I don't reply to Yamato Endo. What if you beat me up? Yeah, go study. I didn't say anything to you. Manufacture and car, inshallah. Yeah, it's exactly format based. And also, there's also, I already have recording on it. Just watch the recording, bro. What do you mean? POE क्या है? What's POE? What's that? That's weird. Anyways, it's the first time hearing that. Anyways, so yeah, you can watch the recording. You can watch the recording. Also, if you want chapter 12, who said chapter 12? This is chapter 12. There you go. Last year's, no, actually, last sessions. I did this in October. You can watch that for chapter 12. Okay, then I'm gonna start. All right, let's continue with chapter 11 now. This chapter is pretty cool. It's about accruals and prepayments, and basically other payables, other receivables, adjustments, income statements, and T accounts for expenses and incomes, all of that stuff. Okay, and inshallah, we're gonna finish this before 30 minutes, hopefully. I don't like how the textbook explains the concepts in this chapter, so I'll explain in a blank page, I think, and I'll probably use the textbook as a reference, but I just don't like the way textbook explains this. Okay. Do you guys know someone? I know someone to teach Spanish, and I don't have someone for economics yet. If you want someone for Spanish, you can DM me or something. We can probably do something about it. You mean like Spanish for IGCSE or like just Spanish? Well, anyways, it's the same thing. Yeah, no problem. I shall claim that, right? Okay, for IGCSE. Yeah, okay. Hopefully, it's the same thing. But like, yeah, like if somebody speaks Spanish, they can probably help you with Spanish, right? Anyways, yep, you can DM me. Okay, let's continue with this. So let's start. It is often necessary to make adjustments to the accounting records in order to present fine, fine, fine. Now, why? Why do we make year-end adjustments? Because if you don't, then you're gonna have like things that relate to previous years and next year's in this year's income statement, and we don't want that. Okay, we want our the income statement for this year to be accurate and to only exactly matching principle to only include things that are relating to this year. Okay, perfect. And we want our profit to be accurate, of course, because if it's not accurate, then like what? Okay. So the examples in previous chapters all assume that the expenses all were paid like for that year and they were paid until that financial year and they did not relate to the previous years and everything. Okay, but that's not really the case for every business. Okay, like if I'm a bad person, I'm not going to pay my expenses, I'm not going to pay them until they're 3 months late. Okay, so I'm a bad guy. What you going to do about it, right? So you have to account for that in your accounting records. Okay, you have to be an accountable accountant and account for everything. I don't know, bro. Anyways, so yep, a similar approach was okay. It applies for expenses and revenue items as well. It's common to find expenses or income unpaid or paid in advance. But in income statement, only items relating to the particular time period should be included. The actual timing of the receipts and payments is not relevant. What matters is not when you pay, it matters for when you pay. Like if I'm paying today for the next 25 years, then what matters is that I'm paying for the next 25 years. What matters is that I'm paying today, like you're not going to record it in your income statement as an expense. You're going to record it as only this year's expense. What I'm saying, you get it. Anyways, you will get it soon. Income statement is prepared for a definite period of time. So like 1 year, usually like 6 months or something. Then this whole concept of only including things that is, relating to this year is the example, say application of a matching principle. Now you need to adjust the income statement with amounts of prepaid or accrued. Where prepaid means that you pay in advance, and accrued means that you don't pay and like you're kind of late and you have to pay as soon as possible. Okay, and the profit or loss will be shown at the more. No, I'm gonna do bank reconciliation, but if you wanna do it like right now, if you wanna watch the recording, then you can watch the recording for the last year's session. It's in things in accounting. Okay, I should take that right. Yeah, and you're still asking. Have some dignity. Okay, anyways. So yeah, this is the reason why we need to prepare and why we need to have these adjustments. Okay, because we don't want to overstate and understate our stuff, and we want to follow the matching principle, and we want our profit to be shown at a more accurate figure and have meaningful comparisons over the years. All right, and yep, only the expenses relating to this year are recorded in the financial statements. Okay. Okay. And accrued expense is expense relating to a particular period time. Like this is such a weird way of defining it, like such difficult terms. Just say that you didn't pay the money and you took the service, okay? Or you took the product, okay? So yep, then fine. I'll explain this in my own way. Uh, yeah, and then you can see that okay, well, whatever prepaid expense. Yeah. Opening balance fine. Combined expense fine. Accrued and prepaid income from opening balances. Like you see, there's so much yak, like absolutely useless yak. Okay, anyways, I'm gonna go like I'm gonna do something super duper cool. I'm gonna flex my topicals. Oh my god, amazing, beautiful. Let's do this. Let's go here. Let go here. Go like ISO. Okay, never mind. Isofusie topicals. And then we just gonna send. And there we go. Thank you, Arlen Saab. Now we're gonna visit site. Super duper cool site. Oh, let's close this. And now we're gonna copy some options. We're gonna go to accruals and prepayments. Let's get here. It should take us there, bro. And then this is the problem. Okay, anyways, accruals and prepayments. There we go. I'm gonna start with some old question because those are difficult, and then some February March question, I guess. And then we're just gonna copy this. Can I not even copy it? Are you serious? Loki is good. Uh, um, yes. What is the latest year paper you added in the topicals? I think 2021 to 2025, probably. I'm kind of lazy to add them. Why? You can use this and then you can kind of, I don't know. Anyways, problem. Yeah, there we go. Let's copy this. Remember question three. Bro, what? Oh my god, okay, anyways, I think I'll just try. Is that copying it? Oh, okay, copied it. And then we can just go 0 4 5 2. We can just go 0 4 5 2. And then we hit search. Back. Paper 22 0 4 5 2. Alright. And we go for paper 22. We go for the question paper 22. Stream 120p to petty cash flows have full questions. Yeah, usually they do 10 times better. Thank you. Is the stream bad quality? Probably is though. Might be. Let's just put this here. It is actually. That's it right now. Let's just bring this here. Really? Wow. I think okay. I think I'm gonna reshare it or something. Since when though? Is it like that for like super long? Also, can I change the quality? I'm kind of on the tab, and the internet's probably not amazing. Get some stop sharing and share again. Was it like that since the start or what? Is it just changed now? Uh, Okay, that's good to know. All right then, let's continue. So we saw question number three is related to what we want. Oh my God, what is this? You see, this is the beauty of all papers. 9 marks for one question, bro. And then there's another question. Perfect. This includes income and expense. All right. Amla Khan is a trader. Her financial year ends on 31st December, maintains one combined account. On January 1, 2014, 3 months rates was outstanding, 4 months insurance was prepaid during the year. Fine, fine, fine. I think everybody who takes accounting and CS has them on the same day. I had them on the same day as well. I had 4 exams on the same day. Yep. No, like for all sessions, like even last year and stuff. I survived. It was easy. I got an A in one subject, and then I got an A star in the other two subjects, like accounting and CS. I'm just so good, right? I'm surprised I got an A star in CS though. Like I was not that good at it, but then I kind of locked in, and then it was fun and stuff. I think I told you like multiple times, but anyways, I had accounting, CS, and then two Arabic papers. I didn't say 4 subjects, I said 4 exams. So I had two Arabic exams and then one CS and one accounting. Super cool, right? Anyways, back to the topic. By the way, are you gonna give accounting? Are you gonna give accounting? Oh, that's sad. Like what about October, November? Yep, two Arabic papers and then one accounting and then one CS. Start topicals. I didn't start topicals, but I'm just doing one topical. Like I'm just doing a question for chapter 11 because the textbook is really bad. So for chapter 11, I'm doing a topical, by the way. Like this is a topical question. All right. Anyways, guys, let's start. Um, should I directly start doing the question or should I kind of explain the question? I think I'll explain how to do this stuff first. What is this now? I think I can add a page with lines. Let's say, what is it? Okay, fine. So basically, chapter 11, I'm going to explain with my own head. Okay, I'm not really using the textbook for this. So, yep, let's go for it. Chapter 11, the chapter is accruals and prepayments. Okay, this is a T account, supposedly. All right, we call this expense account, and then we kind of copy it. Come on, and then we make it an income account. All right, so please check mod mail. Sure, I guess. I don't see any message though. Analyze the question. I will hopefully. I don't need to do some others. Just a little heads up. Oh my god. I'm a fucking try. Alright, anyways. 15 seconds, wow. Thank you though. How to do the written question. There is no evaluation in accounting, bro. This is not business. Literally no evaluation here. But yeah, the five markers does not need evaluation. Two advantages, two disadvantages, one mark for recommendation. Okay, anyways, we're not discussing that right now. I don't have time. We have to finish in 20 minutes. Someone else has a session now, like in 20 minutes. Okay. So we're gonna quickly wrap this up. Expense account, debit side, and this is our credit side. Everybody please focus. And I won't really repeat things. If you forgot it, I'm sorry if you missed it. The debit side is gonna be having assets and the credit side is gonna be having liabilities. All right. Same thing here, the debit side and the credit side. Debit side is going to have any assets and credit side will have any liabilities. Okay, I'm pretty sure we all know why this happens, right? What do you do in the inventory account? Good luck watching the recording. I've already explained it once. If you don't know it yet, you can check the accounting chat and you can check the pins or something or the accounting concepts thread. We have information there. Okay, now I have mentioned assets and liabilities, but I have not really explained anything, right? So when we have expenses, we have prepaid. Sorry, when we're talking about adjustments like accruals and prepayments, we have two things. First of all, we have prepaid versions, and then we have accruals, right? Accrued. So we have incomes and expenses of both types. Okay, prepaid income and accrued income is one of it, right? Let's say accrued income. Is prepaid income an asset or a liability? And is accrued income an asset or a liability? You don't need to conclude your answer, by the way. This question is for chapter 11. Assets. Okay, which one is an asset and which one is a liability? Or are both of them an asset? Honestly, the slow mode is kind of prepaid income is liability, accrued is asset. Yep, okay. So prepaid income is a liability and accrued is an asset. Accrued income is an asset. Okay, fine. What about prepaid expense and accrued expense? I'll say it. Prepaid expense is an asset. Yeah, perfect. And accrued expense is a liability. All right. If you don't understand it, let's break it down. So prepaid income basically means that we paid, uh, like it means that we received money from someone, but we did not perform the service yet. Okay, so we have a liability to perform the service on them, and then accrued income is we perform the service on someone, or you sold goods to someone. For example, trade receivables, right? You sell goods to someone, and then you have to receive money from them. So that is an asset. A trade receivable is an asset. Okay, accrued income is trade receivables. For prepaid expense, it's when you pay money in advance. So, like for example, you paid rent in advance. Now you have an asset. You will receive the rent. Okay, you own that rent, that future rent. You own it. And then accrued expenses. Let's just say you have been living in your home and you haven't paid rent yet. So okay, so that's an accrued rent. You have to pay rent. You owe it to the person you're living whose house it is. Okay, I'm pretty sure that's clear. Hopefully. Okay, now we have. Okay, that's good to know. All right. Now we also have one more thing. We talked about the income statement, right? So we have our income statement here. The debit side of the income statement, credit side of the income statement. The credit side is whatever increases the profit, and the debit side is whatever decreases the profit. Okay. So can you tell me which side will expenses come on? Which side will expenses come on? Debit side. Expenses will come on the debit side, not credit. Stolen, fraudulent, it's going to come on the debit side. Okay, because they're reducing the profit. Okay. So expenses come on the debit side of the income statement, and then incomes come on the debit side of the income statement. So we have our incomes here. Now tell me, if the income statement is being debited with the expense, then the expense account will be credited with the income statement, right? Make sense? And then the same applies for the income account as well. So income statement is going to come on the debit side over here. All right. Now for the balance BD part, we can have a balance BD which is prepaid, or we can have a balance BD which is accrued. Okay. If you have an accrued expense, which side will it come on? Accrued expense balance BD, which side will it come on? Debit or credit? Balance BD for an accrued expense. Accrued expense is a liability. It's going to come on the credit side. Okay, now let's remember when you write balance BD, you have to first write full of it, the full word. Okay, you write the value, and you don't write accrued BD or anything. Write balance BD, and then if you want to write for your own understanding, then write accrued in brackets or whatever. But write balance BD. Okay, and then on this on the debit side, since it's an asset, prepaid expense is going to come on the debit side because prepaid expense is the asset. Okay, balance BD and then prepaid. Okay. Then when you pay money, when you pay an expense, what happens? Well, that's sad. Maybe pay attention next time. For the bank, if you pay an expense by bank, your bank balance is reduced. You credit your bank account and you debit your expense account, right? So this applies for all expenses. Okay. On the debit side of your expense account, you're gonna write bank. Then the opposite is for incomes. If you're receiving income, your bank account will be debited and your income account will be credited. So you're gonna have to write bank on the credit side. It's double entry. I'm just explaining this entry by the way. Like for example, if I pay for rent, how do you record the double entry? You're gonna debit rent account and credit bank account, right? So this is what we're doing. We're debiting the rent account and we're crediting the bank account. Balance BD can be on both sides depending on accrued or prepaid. The asset will come on the debit side and the liability will come on the credit side. Prepaid expense is an asset and accrued expense is a liability. Brother, just think about it. For income, it's going to be the same concept, okay? Which is an asset? Accrued income is an asset. So accrued income balance BD will come on the debit side, and then the opposite is on the credit side, prepaid, because prepaid income is a liability. All right. So yep, that's that. That's the entire thing. And then you have balance CD as well, of course. Let's kind of just pull this up. Then you're gonna have balance CD. This side would be balance CD for prepaid, and this side would be balance CD for accrued. Now remember, when you're checking if it's a debit side or a credit side, you only check the balance BD, okay? If the balance BD for prepaid is going to be on the debit side, then the balance CD will of course be on the credit side, okay? So that's how you understand which side, okay? So understand the concept, not memorize the format, all right? And the same applies here. Prepaid BD would be here, balance BD for prepaid, and balance BD for accrued. All right, and that should total it off, okay? Now that was the explanation part. Hopefully, everybody understands it. Now we're going to move on to the question. Maintains one combined account, which means that we're going to have to balance both of these separately. That's good to know. On 1 January 2014, 3 months rent rates was outstanding, accrued. Okay. Is accrued expense an asset or a liability? 3 months rates is an expense. Outstanding expense, liability. Perfect. Liability. Okay. And 4 months insurance was prepaid. 4 months insurance prepaid. It's an asset, right? 700. Okay. Now, what do we get from this? 3 months rates. 3 months rates is how much? 480. How much is 1 month rates? You can calculate it. Oh my God. 480 divided by 3. 1 month is 160. And then we have 700 for 4 months. 700 divided by 4. 1 month is 175. Okay. During the year 31st December 2014, the following payments were made by check. Rates 16 months to 31st January 2015. When does our year end? 31st December 2014 to 1 January 2015. So we paid 1 month extra, okay? We paid till 31st January, but our year ends on 1 January, okay? Yeah, business is supposed to start. I'm just packing up and I'm just finishing. All right, so 1 month is prepaid. And then over here, it's up to 30 April 2015. And our year ends on 31st December 2015. So I have January, February, March, April. We have 4 months prepaid, okay? All right, but one second. Uh, this is rates owing 3 months, right? So we have 3 months from here, and then 12 months, so that's like 15 months, and then 16 months. Okay, fine, beautiful, beautiful. This looks pretty easy. I wonder if we'll get all marks. Okay, so what do we start with? Balance BD on which side? Of both sides, of course, because it's a combined account. Okay, what is what? This is the assets, this is the liabilities. Come on, guys, nobody answering? The question was which side, what balance BD will we write for and what detail, okay? So on the debit side, we have insurance, balance BD 700 because insurance is an asset. And on the credit side, we have rates, balance BD 480 because it's a liability. It's going to come on the credit side, okay? Then we have payments by check. So bank on the debit side because, yeah, I'm actually just finishing, bro. Just 2 minutes, bro. Trust. General VC. Okay. If you still want to, we can switch it into community. Yep, I get your point. Okay, guys, join general VC. We are shifting, shifting, shifting. Goodbye. Come to the voice channel. General. Bro, which one should I raid? There's a person in general 3 and there's a person in general 2. Should I just raid them? I will raid both. Okay, guys, let's go for it. Accounting students, shoot. Oh my god, this is so rude. Do you not take accounting? Accounting is really good, you know. Need some chai. Business is easy. Imagine taking a business session. Don't you get bored? There's like so much theory. I can't even read it. You know what I did for business studies? I studied 3 chapters for paper one, bro. I studied 3 chapters for paper one, and I got an A star in business. Like, like what? Anyways, all right, guys. You studied 3 hours. I studied 3 chapters in 13 minutes or something like that. Okay. Anyways, goodbye, guys. Let's come to voice channel to general two.